persistent inflationary pressures and more may be likely to come. Then do you look at the earnings to learn more about what's going on in inflation than the backward-looking CPI?
Yes, well, of course, it is backward-looking, and that's where our fingers are crossed. We've all seen the numbers come down. What our biggest worries, and you mentioned, Anne-Marie, what our biggest worries should be, two of them anyway, are inflation and earnings. And inflation being the biggest problem, people can worry, as we do in our business, as to whether or not inflation will move up again. We don't see really good evidence of that, notwithstanding the CPI numbers. What we see is sticky disinflation, and we at Federated Hermes have been suggesting you're going to see that, and you're probably going to see that as a child of the 70s. You're probably going to see that for a lot longer than many people believe, and we're going to have to grapple with that. But it could be okay if earnings stay okay, and earnings have been robust, and we are bullish on earnings at Federated Hermes and going into next year as well. That's what we're going to probably come down to, because earnings tells us whether or not jobs will be preserved or unemployment goes up.
Well, certainly at the moment, Linda, the economy looks strong. Unemployment is low. With the narrative that you just put out, I love it, which is child of the 70s, it's going to be okay. We're going to learn to live with inflation. But that's going to mean an extension of breadth into commodity-oriented stocks, breadth. We're seeing a rally in gold to all-time highs, but we are seeing yields under a great deal of pressure. So how do I live with it and prepare to live with it a little bit more? Sticky inflation, that is.
Well, yes, thank you. That's for a question that's very, very important is in terms of what is going to happen and with breadth. And as you mentioned, one of the reasons why the market has been so good this year is that even as big names like Apple have pulled back, you've seen other sectors broaden in terms of their participation with this rally. And the next logical step after the big cap techs is the rest of techs is then the big cap cyclicals. Have been expecting small caps to start to participate and join in with this, but their earnings have been not nearly as good as the large cap ones were. This is kind of a reflection of the bifurcation that you saw in the 70s, and lots of people believe that you need interest rates to come down for small caps to get the relief, to get the earnings to join in, but they can't reduce interest rates because they see a recession, but rather because they think they've tamed inflation, and this will take longer than many people expect.
Linda, just quickly, I only have about 45 seconds. You said that everyone wants the sell-off and that you're looking to earnings. What kind of sell-off would you be looking for that would get you excited? We were talking to Jonathan Stubbs. He said double digits.
Well, double digit is what people are looking for. That's a decent correction. I don't know that it's appropriate to be excited for anything, because if everybody's looking for something, they probably are not going to get it. There's still too much money on the sidelines. Here's what I know. The first quarter of this year saw the strongest advance in the S&P. It was like the 11th best since the 1950s. If I'm a student of history, that's a long time ago. And historically, the second quarter correction is mild. I position that against the uncertainty of an election year where you usually get a 15% pullback in the summertime.
Yeah.
But how uncertain are we really? We know these two people very, very well.
Linda Dussel of Federated Hermes, thank you so much for being with us. Coming up, Apple overhauling its entire Mac line with new, get this, AI-focused processors. Everyone's so excited. That conversation up next with Mandeep Singh of Bloomberg Intelligence.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
We are seeing a bit of decline across the board after bank earnings kicked off Q1 earnings a little bit with a whimper rather than a roar. There is a question of whether this sort of sets a tone for the rest of the complex. No drama. Let's not get carried away. S&P futures down 0.4%. NASDAQ actually down more after rebounding by a significant degree and outperforming yesterday, down about 0.5%. Yesterday, up more than 1.5%, really led by Apple. We'll get to that in just a second, but also this belief that that will be the haven trade. If you take a look at sort of the reason why this is so interesting is bond yields have gotten to the highest levels of this year, pulling back a bit today from that. But the fact that stocks have been able to rally despite the fact that we're looking at a 4.9% two-year yield menace really is causing a lot of people to wonder, is this a higher for longer regime that stock investors are okay with?
Well, they're certainly becoming more comfortable with it. I mean, if you think it's a slow dissipation, you know, you go from 6 rate cuts back in January time to where we are now. You've got a couple of houses calling one and done in Christmas time. So you're actually going to live in a world of 5.25%. Where do you want to be? And State Street would say that that's in a barbell approach, which is on the left-hand side it is cash, and on the right-hand side it is high-tech with big balance sheets, cash deposits, earning money there versus the cost of capital. And also, you know, the end is not nigh. I mean, look at Apple. I mean, people were ringing the death knell for that company just a couple of weeks ago.
You know, you're going to get me in trouble. Someone's going to say that I set you up to say the end is not nigh, because that's sort of the sort of tone that can happen. The end is not nigh, Anne-Marie. We're looking at a dollar that is stronger, though, across the board. I do want to get a sense, within the markets complex, commodities, to me, has the biggest attention today, given the fact that, yes, gold is at a record high, oil prices rising once again. There is a feeling that a move is underway, and it's not a simple one to explain.
It's not a simple one to explain because in some instances it's a little bit different. Like copper's a little bit more idiosyncratic. It's not really geopolitical. It's the fact that these Chinese smelters may be cutting supply. So you have the demand, obviously, an issue there, and the price moving higher. But across the board, what you're seeing is move into commodities today specifically on all of these geopolitical headlines we got overnight. And there's been a number of them, whether or not it's the U.S. warning to Americans in the Israeli embassy. France has come out with a warning on a number of countries. They're telling French citizens not to go. The world is bracing for this strike from Iran. Whether it's proxies, whether it's Iran, we don't know when, we don't know how, but we know it's coming.
It seems like it's a hard needle to thread in order to retaliate without sparking a broader kind of conflict. Under surveillance this morning, this really is what we've been watching over the past 45 minutes. JP Morgan and Wells Fargo kicking off bank earnings this morning. Both banks reporting net interest income that missed Wall Street estimates. Shares of JP Morgan trading lower in the pre-market pretty materially. Wells Fargo shares actually turning positive. JP Morgan CEO Jamie Dimon reiterating recent warnings, saying he remains, quote, alert to a number of significant uncertain forces. Manus, we've been looking under the hood, and really some of the things that stand out is that their net interest expense how much they're having to pay out in interest has been climbing. And JP Morgan's been adding to headcount, which also really speaks to the expenses, which is really different than a lot of the other banks that are trying to keep their staff levels down or neutral.
It depends where they're actually adding those headcounts. What we've seen, let's just square that away. What we've seen with a number of institutions and houses is they've been reducing headcount on certain product areas, but they've been adding within AI. Here we are with JP Morgan. Look, the story today about JP Morgan, Wells Fargo, and we'll see it with the others when they come through, is what is happening on the net interest income. It was supposed to be guided higher. That's what the market was looking for. All the banks earned $250 billion. The biggest banks earned $250 billion last year in net interest income. And it looks on first flush that it might not just be as juicy for them on NII this year, but it is the first quarter, so we can all just breathe a little.
We have one bank analyst, Octavio Morenzi, writing in and talking about no good deed goes unpunished. The only negative item was, of course, coming from that net interest income. They said everything else was quite well, and they're very bullish now what's going on. Everything else looked encouraging, but you could see how concerned the market is for this kind of environment, for net interest income, if rates are going to be higher for longer.
And it also just speaks to how high the bar has gotten as JP Morgan continues to chuck forward. Meanwhile, a slew of Fed speak on deck today. Excuse me. Happy Friday. It's going to be a weekend soon. A slew of Fed speakers on deck today. Let's try this again. As economists push back rate cut expectations following hotter than expected inflation prints, we'll hear from San Francisco Fed President Mary Daly, Atlanta Fed President Raphael Bostic, Kansas City Fed President Jeff Schmidt, and at 9 a.m. Eastern, Bloomberg's Michael McKee will sit down with Boston Fed President Susan Collins, who came out earlier this morning in a Reuters report saying that she's now looking for a baseline of 2 rate cuts this year, Anne-Marie, rather than the 3 that the Fed had previously been projecting.
And I want to hear what Mike has to say to her in terms of what the Fed is potentially not looking at, where these unknowns potentially coming from, and also how much does she push back on people like Linda Dussel, we just heard from, child of the 70s, we can live with higher inflation, and the fact is earnings will actually tell us if the job market will keep up. Is potentially there any inkling at the Fed to what Linda said, living with higher inflation, Mohamed El-Erian has been talking about, maybe the Fed getting a little bit more comfortable, not 2%, but 2 to 3%?
I think what's interesting is she actually went to the point of denying that a rate hike is something that she's actually pushing back on. A rate hike is not part of her baseline. The fact that you've now actually got somebody in the Fed coming out and talking about rate hikes, no, that's not on our agenda. That just shows you actually, if they're verbalizing that, that's how concerned they are. I think there's a lovely line from RBC. The rickety dam holding back the no landing narrative may be at stake. And that's what we're really here to debate, which is a no landing scenario. And that could be actually no cuts from the Fed this year.
Well, this is something that Priya Misra has been talking about at JP Morgan, this idea that if you actually get rate cuts pushed out for the remainder of this year, the way that markets work is they're going to start to price in some potential chance of a rate hike. That is just how markets work. This is what the Fed maybe wants to push back against. Is it going to be difficult? And will the stock market care? And that ultimately has been what we're trying to parse through all this morning. What influence will it have on a market that is pretty strong, which is the reason why we're so focused on the tech space, right? Because the tech has sort of been its own idiosyncratic secular story. Apple, let's get to this, preparing to overhaul its entire Mac lineup with new in-house chips designed to highlight, that's right, artificial intelligence. This is according to Bloomberg reporting, Bloomberg's Mark Gurman. The new design coming at a crucial time for Apple's computers. Sales of the Mac falling 27% in the last fiscal year. The company is seen to be falling behind its competitors in AI. Again, the reason why people are so excited about the adoption of this technology in a more intimate way. Joining us now, Mandeep Singh, Senior Technology Analyst at Bloomberg Intelligence. Mandeep, how significant of a move is this by Apple?
I mean, look, everyone has been waiting for that Empire Strike Back moment when it comes to Apple, because clearly they still have that install base and distribution on the smartphone side, and also, I would argue, on the notebook and PC side. And look, they control the chip and the operating system. So that's unlike a lot of other companies on the PC side where Dell or Lenovo relies on, Intel to give them the chip. So that vertical integration has always been Apple's strength. And in this case, if they can incorporate the on-device AI that everyone is excited about, I mean, the mood of the moment is, what can you show me on the AI front? And Apple hasn't done that. if they can do it through this chip innovation, I think a lot of people will be excited about their prospects going forward.
This may be a dumb question, Mandeep, but where did this come from? Is this from the car unit that was disbanded and people basically were pushed over to another unit? Was this expected that they had this capability to really inject AI chips this quickly?
I mean, look, they have been investing on the AI side. It's just Apple is always secretive about what they do. And, when they launch a product, that's when you see the real innovation. They've been talking about how they are planning to use more flash memory for AI compared to DRAM, which is what a lot of the companies are doing on the server side. So, look, there have been investments going on, but in the end, you have to show the results in terms of what it could do to a refresh cycle, and how, on the software side, companies and the apps that are built on top of the Apple ecosystem can leverage that. So doing it at the chip level makes a lot of sense, but I think you need to see it in the results in terms of how much refresh it's going to draw.
Mandeep, we were so bearish on the China story on Apple. Wedbush Securities accused of all of us being perhaps too bearish on the China story. And the market, to a certain extent, had got so bearish on the AI capacity of Apple. Here we are. It's one of the laggards in Mag 7. This year, it's down 10%. This is not, in of itself, going to change the narrative for Apple and take us to $4 trillion, as Wedbush Securities suggested it was going to make in market cap, is it?
No, and look, the China revenue, the 20% revenue exposure they have with China, that's going to continue to go down. I mean, clearly they have a lot to do on the supply chain side in terms of relocating the supply chain. So with Apple, it's going to take a while in terms of both the revenue lift. They are the only hyperscaler that are growing, low single digit when you compare them to Microsoft, Alphabet, and Meta, and so on. And so clearly Apple has their unique challenges when it comes to especially the revenue side and the China exposure they have. And that's not going to go away regardless of what they do on the AI front.
Mandeep, this morning we have the Wall Street Journal reporting that China is telling Chinese telecom companies that they need to ditch U.S. chips. We see the likes of Intel, we see the likes of AMD, all down in pre-market based off this report. How big of an impact will that mean for them in terms of their earnings? How big of a blow could this be?
Yeah, so the kind of exposure that Intel, AMD, and to an extent NVIDIA have to China has been going down, and especially with the incremental data center spend that we are talking about with AI, that's probably going to go down even more because every sovereign realizes at this point of time that AI is driven by, these latest chips, and you just can't afford to build it somewhere else. So it will be domestic, and in the case of China, I mean, that's what they're doing with all the infrastructure. It already happened with the handsets and the PCs, and now it's happening with critical infrastructure. And I think it will be a headwind for all the chip makers, including Intel, AMD, and NVIDIA. I think they will be impacted as well going forward.
And potentially it's just going to get worse when we see the geopolitical risk rise between Washington and Beijing. They want to develop more national champions. Is that just Huawei, or are there more?
So Huawei has clearly shown that they have caught up to Apple in terms of the smartphone features, and that's what drove, Apple's decline in revenue last quarter. And it's going to happen with every chip maker in the sense that long term, 5-10 years out, you can model that revenue exposure going down to low single digit or even to zero, because that's what will happen, in terms of the geopolitical tensions and how the sovereigns are kind of thinking, especially around the chip sector.
Mandeep, we've been talking all morning about how big tech has really outperformed, even in light of some of these rate hiking expectations, or not rate hiking expectations. Susan Collins put to bed that, but this idea that rates are going to be higher for longer. How much is this directly tied to that? The fact that they have such huge cash portfolios, as Manis was mentioning, and they're actually reaping benefits from this. How much is that this is still the haven, and how much is this that investors are just confused, and any good story that mentions AI will attract people's money?
I mean, typically an inflationary environment is not good for ad spending. And, in general, the tech valuations tend to compress in times of high interest rates. Now, this space is somewhat unique in the sense that these companies are being treated as, havens, and a lot of the money, the defensive money, is flocking to the companies because clearly they're the most powerful companies if you think about it from a cash flow perspective. And so that, I think, will continue, but I wouldn't be surprised if you do see, some pressure on their top lines because of the inflationary pressures, or if the interest rates remain at this level, especially on the consumer side. I think the enterprise side remains solid because all these companies have the CapEx budgets and they are growing that CapEx to, invest in AI for the long term. But on the consumer side, you're not going to see a quick rebound on PCs or smartphone refreshes if inflationary pressures remain.
Mandeep Singh of Bloomberg Intelligence, thank you so much. Just to recap some of the bank earnings, we did get JP Morgan, we did get Wells Fargo. They're both similar in missing on net interest income. Interesting, JP Morgan stood out for actually increasing its headcount. Curious to see how much that actually does stem from some of the First Republic acquisition. Those shares lower by 2.1%. Also talking about an increase in interest expense, something like 49% of an increase in interest expense at JP Morgan and a 76% over at Wells Fargo. Wells Fargo shares have turned positive. JP Morgan's still lower. Citigroup on deck. Stay with us for that 8 a.m. Eastern in about 16 minutes. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hawkins. Yahira.
Hi, Lisa. KKR is taking a cue from Berkshire Hathaway by betting big on long-term private equity, plus the resulting dividends. In an exclusive interview, co-CEO Joe Bay told our own Lisa Abramowitz the company expects to see $300 million of dividends in its strategic unit by 2026, with plans to double that by 2028.
Berkshire Hathaway is an apt analogy in the sense that we look at a lot of business models, why certain firms have been super successful over time. And there are a lot of powerful messages in what Berkshire has built. It's the power of long-term ownership of assets, great businesses, the power of compounding, and the real power of smart capital allocation within your business.
The Biden administration is ramping up its aggressive economic stance toward China. The Commerce Department added 6 new Chinese companies to a blacklist on exports this week. That brings the total number of firms blacklisted by Biden to 319, the most of any U.S. administration, and topping the 306 that Donald Trump added while in office. And Samsung is preparing to announce a $44 billion investment into U.S. chip making as early as next week. It's a signature project in Washington's broader effort to bring semiconductor production back to America. Sources say the world's biggest memory chip maker plans to outline the project in Texas alongside Commerce Secretary Gina Raimondo. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, pushing back the rate cut timeline.
The recent data have not materially changed my outlook, but they do highlight uncertainties related to timing and the need for patience.
That's up next. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It is anything but boring. We are looking at markets that are digesting the 1, 2, 3 punch of CPI, PPI, and then bank earnings. Welcome back. We are seeing the equity market retrace some of the declines from earlier as they really digest some of the earnings from the likes of JP Morgan and Wells Fargo, down about 0.25%. And what we can see is a real question about what higher for longer means for banks. We are seeing this question of net interest income coming in beneath expectations at both JP Morgan and Wells Fargo. Question is, will a protracted high rate environment actually be a good thing or a bad thing? The perennial question. The answer often is, it depends. Under surveillance this morning is that rate cut picture, pushing back the rate cut timeline.
The recent data have not materially changed my outlook, but they do highlight uncertainties related to timing and the need for patience, recognizing that disinflation may continue to be uneven. And this also implies that less easing of policy this year than previously thought may be warranted.
Here's the latest. Treasury is looking to regain some of the losses as investors push back rate cut bets following yet another hot inflation print. Bank of America, Deutsche Bank, both of those banks now forecasting a first rate cut in December. While Colin Martin of Charles Schwab writes this: we are revising our outlook to 2 rate cuts this year from 3, but that can change if inflation remains stickier than expected. Inflation is still high now, but we're not convinced it will reaccelerate. Rate cuts should be driven by the wish to normalize policy rather than a need to stimulate economy. Colin, dissecting which is which has become increasingly difficult at a time where we don't know exactly where the neutral rate is. I want to start, Colin, on this idea of just how much the data that we got this week really reset expectations. How much did it shift your understanding of how sticky inflation is and whether this disinflation narrative really has legs?
It did shift our understanding and expectations. Coming into the year, and as recently as a month or even 2 weeks ago, we were still in the camp that 3 rate cuts seemed appropriate. If you go back to the end of last year, I mean, most inflation readings were continuing to fall. We saw annualized rates of close to 2% or so. And what we saw this week is that it is sticky. I mean, 2 months, maybe you can say that's a blip, but 3 months and the CPI beating expectations, that shows that it is sticky, and especially on the super core measure. I mean, that was concerning.
Yeah, this is a reason why I think people are kind of struggling with what to do with this. Because on one hand, higher rates were thought to be good for risk assets because they came for the right reason. It was because it came on the heels of growth. Are we seeing that fundamentally challenged right now, especially as you see high yield kind of take it on the chin a little bit? You see people start to wonder, okay, higher for longer, what does that actually look like?
Well, we think that is a risk there. If you look at high yield, it's held in really well. If you told us that the Fed would hike aggressively, maintain, and now actually risk holding for even longer, and we'd see high yield spreads at 3% or less, we would have said you're crazy. That was not our expectation. So far, they've done okay. Profitability remains really strong. I think that's been a key driver. But we're concerned about the for longer part, because if you're an indebted company, how long can you really withstand such high rates, especially if you don't expect that profitability and the rate of profit growth to continue, which we wouldn't expect as this kind of recovery expansion continues. We'd expect growth to slow, and if you're seeing borrowing costs 7, 8, 10% or more, depending on credit quality, we think that's a risk. So we are still concerned with those risky parts of the market, and we think a higher for longer is bad for risk assets.
So do you, as you see the way forward, there's no landing scenario seems to be building, whatever that will be. But the Fed and Powell himself used the language restrictive. That was just 10 days ago. What is it that the Fed needs to do? Do they need to do 1 to 2 insurance cuts? Is 1 or 2 cuts in insurance, but then we go into an extended pause, as we had back sort of 10, 15 years ago?
I don't think they need to do that. We've heard Powell talk about Volcker and really the need to kill inflation. And I think the risk of cutting right now, especially given the still high inflation, I don't necessarily think that's the move, and I don't think they're going to go down that route because they know the job on inflation is not done. We're seeing that from a lot of officials lately. If you go back a few months ago, there was a lot of optimism, and when they talk about rate cuts, I don't think it was the need. What's
the risk to this bond market then if it is no landing, it's 1 rate cut, maybe even no rate cuts? Do bonds then burst through to 5%, or does real money come in at these levels?
I think we start to see real money come in. To see yields move sustainably higher, I think it does go back to the neutral rate that Lisa just referenced. What is it and how restrictive is policy right now? The risk we see is if there is this no landing economy and inflation stays high, the Fed wants to kill that. And so we're afraid that if the Fed holds for a very long time, or if they hike again, not our base case, but it's certainly possible, we think that slows down things too much that we don't see yields surging.
We see commodity prices higher. We see wage growth really not ticking higher because all the supply that's coming to the labor market. Why are you so sure that inflation won't reaccelerate? Is it because of that supply on the labor side?
I think it's part of that. I think the Fed is committed to bringing it down. If we look at the labor side, it's still strong. We can't get past that. It's slowly weakening. You mentioned wages. I think that's important. If you look at wage gains, that has continued to trickle lower. If you look at a wage gain on an hour on a yearly basis, it's still coming down versus sort of the stalling and potential reacceleration with inflation. So I think that's something we're really looking at. And if those wage gains do continue to fall, we're not convinced that we'll see a reacceleration in inflation.
Colin, I want to tie your world to the bank earnings that we just got. This idea that net interest expense at the biggest banks went up. And this speaks directly to the fact that everyone wants to park their money in money markets and clip 4.5% rates. How much is this because right now investors view cash as an asset class, are very choosy in terms of where they go, and they want to get a higher yield and are demanding it so that these banks, even the biggest, have to offer that to keep their money?
Yeah, absolutely. We're seeing it at Schwab. People are finding those opportunities. Now, we still think investors should move further out in the curve and lock in yields with certainty, but what we're seeing, not just at Schwab, but pretty much across all banks and brokerages, is that need for or interest in short-term high yields. It's tough to argue against a money market fund at higher than 5% with very little price stability. We get that. And we're not saying investors shouldn't do that, but when you mention as an asset class, cash is an asset class. But if all your fixed income allocation, or what should be earmarked for fixed income, is in cash, then you sort of lose that diversification aspect.
I guess I'm thinking about if it is some sort of asset class, investors are going to be much more choosy about how much they get and are going to demand it. Do you find that the money is sticky or less sticky than we thought during the March financial crisis that wasn't last year when it comes to sort of shopping around for the highest rate?
Yeah, no, I think we'll see that. And investors and consumers are smart about that. They see what rates are out there. In this world we live in, you see numbers all the time, whether it's on TV, social media. It's hard to not see what's available elsewhere. So I think that's a good thing, though. You want investors to shop around and find the highest yield out there, but always be cognizant of what those risks are. So I want to go back to that point that yield we see in money market funds or T-bills, it's not permanent.
Well, it's a good thing if you're on the investing side. Maybe the banks will have a different story to tell when they have the earning calls. Colin Martin of Charles Schwab, thank you so much for being with us. Coming up, Anastasia Amoroso of iCapital, Ken Leon of CFRA will join us again as we break down Citigroup earnings. Neil Dutta of Renaissance Macro to push back on the idea that inflation is going to surge higher from here. Jill Carey Hall of Bank of America on small caps, really an interesting asset class that may not catch up with large caps anytime soon. Right now, Anne-Marie, I know you're very closely watching the commodity space, which I'm very glad about because that has been a main driver. What do you think right now, based on the price movement and some of the forward expectations, are you seeing in terms of how significant the shift is right now with Iran preparing to strike?
Well, I think what you're seeing, and you look at the call options in the options market, people see upside to Brent this summer. The question is, what happens after that?
And this is the reason why people are looking at this as inflation, disinflationary story. How do you factor this in? It's whack-a-mole today on Bloomberg Surveillance. Right now in markets, you are seeing a bit of a retracement from earlier losses. Bond yields lower for a change, down 6 basis points. Up next, Citigroup earnings. This is Surveillance.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Our attention is really shifting to the earnings season.
The Max 7 is not particularly where you want to be, but you have to look at tech overall and really bet on quality, strong balance sheet.
You want to see some earnings momentum in the other parts of the market.
We are looking at this sort of broadening out of the recovery as the earnings story gets better for the have-nots of 2023.
I just look at what's been happening to this economy, and I do think that we're going to be able to avert a recession. So we'll continue to see earnings continue to move higher.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
I'm going to say it again. Let's get you to the weekend, although it seems like a long way away because we're getting a lot of information coming through. Good morning. Welcome back. This is Bloomberg Surveillance from New York City live. We are here with Menace Cranny and Anne-Marie Hordern. I'm Lisa Abramowitz. John Farrow off today on a well-deserved break. We have been talking about break earnings, and we did just get Citigroup earnings, just to give you a sense. They did beat across the board with actually their fixed income commodities and currencies trading and sales coming in at $4.15 billion versus the estimate of $4.12 billion. Net interest income coming in. We're going to parse through all the numbers and we'll get there in a second. Citigroup shares up about 0.5%. But in the meantime, this comes as a sort of motley drumbeat from JP Morgan and Wells Fargo. Anne-Marie, I'm struck by the fact that they don't tell the same story when it comes to just how investors are receiving it, but they do tell the same story when it comes to net interest income and net interest expense.
It's all about net interest income, and JP Morgan on that miss is what is really dragging down the stock, even though a lot of analysts are saying this was a pretty good report. Earnings expense as well, guidance higher. Shinali was talking about this inflationary pressure even the banks are seeing. We're also going to get JP Morgan a media call around this time as well, so some of those headlines will be trickling down.
Manus, what stands out to you as you sort of parse through everything we've gotten so far?
The margin compression we'll spend more time with Shinali on. For me, it's about the credit provisions. They are materially lower in Wells and JPM than they were estimated to be. Looking at Citi is going to be driven, there's a banging number in here on investment banking, 903 million. The estimate was for 776, and that really plays to that spike at the start of the year that we were seeing across investment banking. The flow show was improving all the way around. certain amount of that has dissipated as the quarter went on. So FIC doing really, really well as well there. But it's about the credit losses are materially lower than estimated. JPM, Wells Fargo, I've yet to see the Citi number, but we'll get that.
Well, we'll dig through this, and you mentioned Sonali, she'll be coming up in just a minute. What we are seeing in broader markets is a retracement from the earlier sell-off that we had been seeing this morning. We're seeing a decline of about 0.25% in the S&P. We're seeing dollar strength across the board continue. 106.54 on that euro, as it does seem like the ECB is preparing to cut rates in June. 10-year yields, this is interesting. Have we reached the point of buying? A lot of people saying it looks like a buy, and yet we had a couple of auctions that were pretty messy this week. 10-year yields now lower by almost 7 basis points, 452 if you round it up. And crude rallying, Emery, and we've been talking about this. This is sort of the drumbeat behind all of market activity, this question of at what point this becomes a dominant feature in a market rally that has so far viewed this mostly as a demand story and not necessarily a shock.
Well, right now, this is all about geopolitical risk across most of the commodity space. You see that with gold. There's been a lot of stories there, but today it's really about this geopolitics because overnight there's been a drip of stories that are a little bit more tangible than just reports of an imminent strike. You're seeing France, you're seeing alerts from the US about certain embassies, where to and not travel. There's obviously intelligence behind this, and Israel is bracing for some kind of retaliation from Iran.
And it's important to keep an eye on this because that's sort of the drumbeat in the background as we do focus on bank earnings as they come out. Coming up, iCapital's Anastasia Amoroso on why rate cuts don't pose a risk to the rally. Renmac's Neil Dutta on why he sees an initial cut in July, and Bank of America's Jill Carey-Hall on small cap risks. Right now, we do want to get some sense of what Sonali Basak is seeing in Citigroup earnings. Sonali, you've had a couple minutes. What's up?
A few things, a lot of beats to look at here. And of course, if you want to see progress here for Jane Fraser in her turnaround story at Citigroup. Coming into this earnings cycle, they were trading at just over 60% of their price to book value here. So of course, Citigroup has a ways to go to catch up with these other banks. When you look at what they've done, what's most impressive perhaps is the gains that they're making in terms of beating on fixed income trading, equities trading, and investment banking. We talk a lot about that private credit competition. Interestingly, now you have JP Morgan and Citigroup beating on debt underwriting very meaningfully here. So you're seeing the banks come back with a vengeance to get that share in the markets, and you're seeing them really put their money to work to do so.
I mean, this report card on Citi really plays to what Jane Fraser said when she was at the the RBC Capital Markets Conference, which was, we are ahead on our program. And that's reflected. If you look at the inside the business, FIC is significantly is a solid number. It's well ahead of what they had estimated. Likewise with equity sales and trading. So do you think the transformation of Citi, is there another leg to go? Is there another evolution of that from Jane Fraser and the team?
There certainly is. I would have to say those businesses right now are extraordinarily competitive because by and large, those businesses are kind of flat to down on Wall Street. But Citigroup, big global presence, and therefore when it comes to fixed income...
I think that's the big differentiator with them as well, is the globality of their business.
Absolutely. So what it does is give her a chance to gain share in securities services, moving money around the world, and also really gain share in those very volatile macro markets, which is why fixed income is so important for Citi. I would say, remember, she's doing this while basically changing almost every top position at the bank. That is the part that is perhaps the most striking about this beat. You have new leaders in almost all of these businesses, and some of them have not even started the job yet.
Sonali, stay close. Thank you so much. Sonali Basak there. We do want to get a reaction, and frankly, iCapital's Anastasia Amoroso has been absolutely brilliant on being in risk during the risk rally. She is sitting here alongside us, Anastasia Amoroso of iCapital, Chief Investment Strategist. We've gotten some bank earnings. I would love to just first get your reaction on what we've seen so far.
Yeah, I'm not surprised that investors are having a bit of a difficult time parsing through bank earnings because there's not a clear-cut story uniformly positive or negative across all the different sectors of the banks. And the negative story clearly is the net interest margin and kind of lack of improvement they're forecasting there. Look, if the Fed does not cut rates and if bank lending is not going to pick up, and that's sort of the status quo that we have today, it's really going to be difficult to see sequential increases in net interest rate margin. So anybody who's overly reliant on that core banking business, I think that's going to be kind of a lackluster story. But then on the flip side, Lisa, I do think what's notable is the strength in trading and the strength in investment banking. I mean, Shanal is absolutely right. We're seeing a tremendous pickup in issuance of leverage loans, of high yield bonds, and also even equity capital markets are picking up in the secondary part anyway.
A lot of people used to think of the bank earnings, JP Morgan in particular, sort of kicking off the earnings cycle and setting a tone for the rest of it. You're bullish. You think that it doesn't matter whether the Fed cuts rates this year because there is enough strength underpinning some of what we've seen in the equity markets. Does this color your view at all, considering it's not being received all that well?
No, not yet. And, first of all, banks have done phenomenally well leading up to this very data point. I mean, they've been outperforming, actually, or performing in line with the S&P. So I think a lot has been priced in. So that doesn't color it. And look, the market right now is in a bit of a digestion period where we do have to reprice for the prospect of potentially no rate cuts. Understandably, so that's going to take the markets lower a little bit. But what I actually like about the setup now is we came into April with weeks of overstretch, overbought market conditions. We came into the year with a 10-year that was probably not reflecting the growth environment we're going to have. But now you fast forward to whatever date it is today, almost middle of April, the 12th, thank you. Then you got the 10-year Treasury trading at a yield that is above what is implied by fair value. You have the overbought conditions that are not there, but we're sort of middle of the range. So you had a bit of a reset from the technical standpoint. So I like that. And then on the flip side, what we also see, Lisa, is an acceleration in manufacturing, acceleration in the cyclical parts of the economy. It's not just the U.S. consumer. So I like that this is not just a one-engine economy, but sort of maybe several things working in favor.
Listen, all we've had this week is a little bit of healthy volatility. Stocks did not get annihilated. They held up really quite well, given that bonds traded so viscerally this week. We wanted this small drawdown. Now, the question is this where you just see incrementally adding risk? Do you think we're going to get a more extended drawdown on this no landing scenario as it builds, as people believe less and less likelihood of cuts? I mean, things are going to slow down in terms of momentum.
Yeah, no, I think the no landing scenario is good for markets. And I mean, think about it this way. If we can have an economy that is growing at 5% interest rate, so if I can participate in the stock market and I can participate in the money market fund, that's a very healthy environment for investors. So, one of the other things I was encouraged by so far in the technical front is that the NASDAQ 100, for example, dipped to 50-day moving average and sort of started bouncing off that level. If you look at the S&P, again, we're sort of, we were toying with 50-day, and yet we're trading above that. So I think this story of cash on the sidelines, I mean, the stats, but 20 or 30% of private clients, or 20 or 30% is the cash allocation or money market allocation for a lot of private clients. So I think that's why, man, as you see these dips, and investors will come in as long as the economy is strong.
Yeah, and there's lots of people out there hunting for the best cash deposit out there. The one thing that we did talk about over the past couple of hours was the resilience of the Mag 7 in terms of the mini ride that we have had and where money is holding out. There's a barbell approach, which is to cash and to big tech. On mini drawdowns, it must be quite tantalizing to think about Mag 7 again. Everybody wanted to sort of divest and broaden out, but on dips, are they a buy?
Absolutely. I mean, that's what we saw in the price action yesterday, is we saw this strength coming out of the Mag 7 once again. But I do think, one of our themes coming into the year was a broader opportunity set. And, we still see that story playing out, specifically in cyclicals. So yes, I want to stick with parts of the Mag 7. I want to stick with parts of technology. But what's really interesting is the manufacturing momentum is picking up. Historically, that lifted cyclical parts of the stock market, cyclical sectors, and also regions. So that's why we look, of course, to the U.S. to have some of the highest earnings revisions momentum, but also Japan. That's why we look to industrials, materials, consumer discretionary, semiconductors, of course, to have some of that upwards earnings momentum. So those would be the parts of the economy that I would be adding to. And the other point, man, is on rate cuts or lack thereof. Yeah. If the Fed doesn't cut rates, you could have a little bit of pressure on valuations, but how do you offset that pressure? By higher top-line growth and by higher earnings growth as well. So that's why if I have a cyclical that's actually accelerating this environment, I think that's exactly where you want to allocate.
When you're looking at this commodity story, you see that momentum really globally, but also in the United States. Do you think then what we're seeing in commodities and this rally higher is longer than just this temporary blip some are talking about?
I do. You know, first of all, owning oil here, of course, is a geopolitical hedge. It always has been, it likely always will be. And so, you know, what's happening in the oil market is we're seeing lower inventories that are being drawn. We're seeing better balances for the rest of the year. And so, of course, you have the geopolitical risk premium that I think, unfortunately, is here to stay for some time. But outside of oil, I do think you have, again, this pickup in the industrial complex. And when we look at the data, the average manufacturing upturn lasts about 9 months. So this is not a blip, but likely several months worth of trend. And if that's the case, commodities like copper, aluminum, some of the industrials should also participate in that. And they historically have outside of COVID.
Anastasia Amoroso, thank you so much for being with us.
Thanks so much.
Of iCapital. Before we get to some of the other things to watch, Shonali Bostic's still here. Just quickly, is there anything that stands out as you parse through the deeper look at Citigroup?
I'm looking through just how much you earn in one of their key businesses, the security services, right? You have closer to 5-6% returns on common equity for the whole business. When you look at the security services business, that is way higher. And it just shows you the direction of travel that is the potential for Citigroup to start to reach as they invest. You have the first couple of words in their presentation, Lisa, relentless. And I think that sets the tone for what Jane Fraser is trying to get across to the street.
And this was a component of the CPI as well, that the security service increase in terms of inflation. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The Wall Street Journal reporting that China has told telecom carriers to phase out foreign chips by 2027. The move part of China's ongoing effort to phase out American technology. Chip makers Intel and AMD cited as likely being hit particularly hard by the change. Officials are pushing firms to inspect their networks for any non-Chinese chips and draft a timeline for replacing them. Oil is resuming gains to end the week. Crude markets are bracing for possible strikes by Iran on Israeli targets. Bloomberg is reporting that U.S. officials and allies believe Iran may attack in the coming days. The move would be in retaliation for an Israeli attack on its embassy in Syria. The news comes as Russia has stepped up attacks on Ukraine's energy infrastructure in recent days. U.S. Steel shareholders will vote today on a bid by Nippon Steel to take over the company. Investors are expected to approve the deal, but it's coming under growing scrutiny from regulators, lawmakers, and President Joe Biden. Nippon is offering $55 per share for a total of $14 billion, which would make it one of the largest steel mergers ever. That's your Bloomberg Brief. Lisa?
Yahira Hackes, thank you so much. Up next, big banks kicking off earnings season.
The first quarter of the year is always the strong quarter for investment banking. Yes, there's numerous geopolitical risks out there, but unless the markets really collapse, which we don't expect, we expect to see a decent investment banking year.
That's coming up next as we dissect the Citigroup earnings. This is Bloomberg Surveillance.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level up your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
But what also makes net interest income an opportunity is the flywheel of higher volumes, whether it's in loan or for Citi in treasury and trade activity. There's opportunities here, particularly with the strong economy, for these banks to surprise on the upside. I think the managements are being conservative. Citi is holding firm on higher revenues this year in their guidance, although net interest income is likely to be moderately lower, but I think that might be a beat as we get later in the year. So I think there's opportunities here for the large banks to really be still strong participants in the equity market, and they're really dependent on for the financial sector for investors to do well.
With Citigroup in particular, as it just crossed about 20 minutes ago, how much is this an endorsement of what we're seeing from Jane Fraser in her overhaul plan?
It's a great question, and what we're seeing in the results, but also in the presentation and the narrative, is transparency of a rock-solid strategy. They did bring in new management at different levels. Of course, they've reduced the management structure, but Citi's not going to be all things to all people. No longer the supermarket, this Sandy Wheel era. This is going to be a bank that's highly focused and relentless to be a partner for institutions on global trade, to be best in class in terms of global wealth management, and then also to look for opportunities where Citi can really leverage that connectivity around the world. But they still exited 14 non-U.S. consumer bank locations, and they're being smart in terms of freeing up capital. Good for investing in the business. It's also good for return of capital to investors.
And Jane herself said this is a cleaner, simpler management structure that fully aligns to the facilities of our strategy. With that in mind, what is the next evolution here, Ken, as you look at JP Morgan, Wells Fargo, and Citi? Is Citi just a much bigger global eco play relative to JPM and Wells Fargo?
Yeah, so they're all very different, and I think J.P. Morgan is best in class in terms of institution, consumer, and for business lending. Wells Fargo, we actually viewed more to be more of a U.S. super regional bank and one that would be more compared to a PNC or a U.S. bank. And then Citi, it's interesting, and this question came up last quarter here on Bloomberg, is going to be more of a streamlined bank, not all things to all people, and be really effective in certain areas where it can be a top 3 player. Bank of New York, of Mellon, I think of different banks that are more specialists versus being versatile and being everything to their customers.
We now have these 3 major banks on tap. Next is going to be, of course, Morgan Stanley and Goldman. What we know from these 3 banks, what are you expecting from the other 2?
Well, I mentioned it before, is we had record debt underwriting. It was the highest since 1980 in the first quarter. That's a positive because that means corporates and CEOs are looking for capital raise, whether it's in debt and soon to be equity. We think when we look at investment banking, it's going to be improving. So I think Morgan and Goldman Sachs are probably going to be conservative, but what they're going to talk about is the durable recurring revenue of their fees, so that it's not the volatility of whether we had a good quarter in trading or investment banking. I think David Solomon's going to be coming out with a lot more confidence because we're really looking in the rear mirror to all of the problems we've had before with the consumer banking and diversifying. This is a rock solid business that's adding an asset management and moving into private equity and private debt. So opportunities here for these 2 banks. Unfortunately for Morgan Stanley, the headline news from yesterday is there's a lot more government scrutiny to some problems that have come up related to wealth management. So that's a little disconcerting.
Ken, just quickly here, I'm curious about what this means for the smaller banks, considering that they don't necessarily have the same kind of banking engines that can offset the declines in interest income.
We look at them very closely, and our team still feels that there is risk exposure here to, of course, commercial real estate. They're much more rate sensitive. But my analysis would be that the small banks are like small cap stocks, because when we look at equity investing and the institutions, there's about 12 constituents of the financial sector that are 65% of the weighting, and 6 of the largest banks are there. So as you go further to the smaller banks, they become of less consequence for investors, but they're incredibly important, of course, for our U.S. economy.
Ken Leon of CFRI, thank you so much for all your time with us as we parse through the big 3 that reported. Honestly, fascinating to me, the net interest income pressure, Emery. That's something that just keeps coming back. This question of, are higher rates good thing or bad thing for banks? So basically just, have we priced in too much optimism?
Priced in potentially too much optimism. It also depends on what the bank is. Big banks can deal with higher interest rates. Smaller banks, not so much. What's catching my attention now is a readership spike in what Jamie Dimon is saying. And he's saying the most important thing to the future of the free world is what's going on with global geopolitics. Potentially, that could mean more of bad economic outcomes.
Well, and this is a reason why he was talking about some pessimism despite some of the optimistic sense for his business. We will keep on top of that. Coming up, we're going to speak with Renmac's Neil Dutta on why July could be the earliest rate cut, basically saying, everybody calm down, they're still going to cut rates, so stop talking about rate hikes and all of that. You're watching Bloomberg Surveillance.
names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to...
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Forgot the word earlier on. It's U.S. exceptionalism.
Meanwhile, what JP Morgan did with interest margins and borrowing, et cetera, it doesn't even matter because he came out, Jamie Dimon, and said that he's worried about geopolitical reasons and concerns that might trump other things. Which brings us to China. President Biden surpassing Donald Trump when it comes to blacklisting Chinese entities. The Commerce Department adding 6 Chinese companies to an export blacklist this week as the White House continues to try to kneecap China's access to U.S. chips and technology. The move bringing the total number of firms blacklisted by Biden to 319. That compares to 306 fewer that Trump added while in the White House. Emory, you've been pointing to this and talking about this with respect to what's going on with Intel. How much is this sort of a drumbeat that just keeps on getting louder, even if other stories kind of overwhelm it?
I think one thing you can take from this is the signal that whether or not it's Trump 2.0 or Biden 2.0, export controls on China will continue, regardless of who is in the White House. And then you wake up this morning, you see what the Wall Street Journal reports, that China is telling their telecom company that they cannot use U.S. chips. You're starting to see the tit for tat. What does that mean for Intel, NVIDIA? All these companies are going to want to lessen their China exposure because China's not going to allow them to use their chips. And then you're going to see a ton of national champions in China, like Huawei.
Which is the reason why we are watching import and export data pretty closely. We'll get to that in 1 second. We just got a slew of new information under surveillance this morning. Fed President Susan Collins urging patience before easing. Collins saying, quote, "The recent data have not materially changed my outlook, but they do highlight uncertainties related to timing. This also implies that less easing of policy than previously thought may be warranted." Bloomberg's Michael McKee, our own, will be speaking with President Collins this morning at 9 a.m. Do not miss that. Mike joining us now to talk about that. But before we get there, Anne-Marie talking about the tit for tat and imports and exports. We did just get some import and export price data. What does it tell us?
We got to cap the week with some more inflation news that oil prices are expensive, but other imports are not at this point. According to the BLS, import prices went up by 0.4% during the month of March. That's more than the 0.3 last month, more than the 0.3 anticipated. But take petroleum out, and and import prices were completely flat. Which is an improvement on the 0.1% rise the month before. And of course, in January, we had a big rise of 0.8%. So things are looking better on the import price front, with the exception of oil. Year-over-year basis, import prices up just 0.4%. So maybe we're seeing the possibility of a turnaround on this whole inflation thing. And you notice that all the people, all of my nerdy economist friends who do the translation between CPI, PPI, and PCE are saying PCE could come in much lower than CPI. So that's definitely something to ask Susan about.
I was going to say, when you speak to Susan Collins, do you think it's something she's going to push back on? We have to wait to see the PCE. We have to remain this confident, see more data. But how concerning, if you're sitting at the Fed, is commodity prices, especially going into the summer when everyone was expecting a cut?
Well, it's concerning, but not overly so, in the sense that the Fed can't do anything about commodity prices. You can raise interest rates all you want. Gasoline prices are going to go up or down, independent of that. Same with other commodities. So the Fed can't affect that. So they have to look through that sort of into the things that they can affect. What I think would be interesting to talk about, and I know she's probably listening to me right now, is she and others have said we don't need to act right now. The markets are all taking this as a turning point, and they've priced out everything except maybe 1.5 cuts this year. Is it a turning point, or is this just overreaction by the markets to one data point?
That's a great question. I'm going to pose it to our next guest. Michael McKee, thank you. Great job. I'm very much looking forward to hearing your interview with Susan Collins. Renmac's Neil Dutta joins us now with an answer to that question. Is this a pivot point this week, or is this something that just is more noise, more bumpiness to the same road to easing policy?
Well, I think the latter. I think it's a bumpiness on the path to still a couple of cuts this year. You kind of have to take the data as it comes to you. And certainly what we learned in the last week definitely throws a bit of cold water on the idea that residual seasonality was a big driver for why, we sort of missed the boat on inflation the first couple of months of the year, because March was still somewhat firmer. The PPI data certainly took some of the edge off in terms of what it means for PCE. But at the end of the day, you're talking about core inflation, PCE inflation, likely to be running above 3% over the first 3 months of the year. So the way I'm thinking about it is, July at the earliest. We had 3 months of poor inflation data, and you're going to need at least that many months to undo the damage. So lots of things have to go right, but I think July at the earliest is probably the way I would think about it. And if you get another bad inflation number, you just push it out. I mean, Lisa, I do think it's worth reminding people that, I mean, you have to kind of go back to first principles in these sort of situations, right? I mean, we know the labor markets are cooling. We know that inflation expectations haven't really moved if you look at surveys of consumers and households. So at some level, that suggests to me that consumers are somewhat resistant now to taking on higher prices. And so if this continues, I'd be frankly more worried about corporate profit margins than anything else.
Well, Neil, this really raises a question about whether this sort of challenges a bullish thesis in equities more significantly than people are realizing. If you do see slowing under the surface, if you do see people pushing back on prices, the inability for companies to pass along things like oil prices and other commodities that are coming up, how much does that really make you less optimistic about what we get in the equity market?
Well, I mean, right now, the markets are kind of trading, right, at any given point in time, I think you could basically say, the economy is, one of four things, right? We could talk about soft landing, sort of, solid growth, benign inflation. We could talk about inflationary boom, or you could talk stagflation or a recession, right? Deflationary bust. And right now, I think the markets are kind of thinking inflationary boom-like dynamics. I mean, that's an environment where, stocks can work, bonds can't. If you kind of move towards a situation where inflation stays sticky, that begins to erode household incomes, it keeps the Fed off on the sidelines, then you're talking about a situation where equity markets will come under more pressure. I don't think we're there yet, but certainly if we can, because I think inflation will cool, but if it doesn't, then you have to be cognizant of that risk.
And that's maybe what the bond markets, Neil, good morning, the bond markets have been trying to price. They did 30-odd basis points in the space of 2 weeks. We've got a little bit back this morning. We've had a couple of auctions this week, which it took more to encourage people to buy the 10s and buy the 30s than it has for a long time. Now, that's because of market dislocation. But I'm looking at my inbox from Torsten Slok, and he says, we are seeing the first signs of U.S. financial stress appear. Trailing treasury auctions, rating agencies issuing opinions about deteriorating fiscal situation, and term premium trending higher. What do you make of that, the dislocation in the auctions this week? Idiosyncratic or something more malevolent?
I mean, I think it's, I think financial conditions have tightened. If you look across a range of different indicators, right, the dollar's going up, corporate credit spreads have tightened. I wouldn't say that it's a significant dislocation yet. I mean, I still think that, financial market conditions, have largely repriced because inflation has been higher. So, that's going, so in other words, inflation's higher. It's going to take a little bit weaker growth to get inflation back to where the Fed wants it. And so you're seeing financial conditions tighten. I don't think it's anything beyond that just yet.
Neil, we have some more news. We've been reporting all week that this attack potentially from Iran on Israel was going to be imminent, and we have reporting that it's going to be within the next 48 hours. We've seen a few signals from that, whether or not it's the U.S. directing embassy personnel in Israel where they should and should not go, France putting certain countries on no travel lists. Last time we spoke, you pretty much shrugged off geopolitics. At this point, how can you not say that this is not concerning at all to what is going on when you look at the global marketplace?
Well, you don't shrug it off. You just, you take it as it comes to you, right? I mean, in my experience, like changing a fundamental forecast based on what's going on geopolitically is usually, by the time you start doing that, usually the crisis is over. That's in my experience. Now, what I will say, to me, the most interesting thing is just the relationship between what's going on in the energy markets and the dollar. Historically, everyone's thought, dollar down, oil up. But given the U.S. position as a major commodity exporter, and we run a net surplus in petroleum, you're seeing stronger oil prices boost the terms of trade of the U.S. and that strengthens the dollar, right? So the causality is actually from oil to the exchange rate in the U.S. I think it matters more, frankly, for emerging markets or oil importers globally, because not only are they dealing with higher oil prices, they're also now dealing with weaker currencies. And that's going to limit the ability of those central banks to cut interest rates, which has been a reason for some of the enthusiasm in global risk appetite, right? So I think it introduces a little bit more tighter financial conditions, particularly in the rest of the world, I think, more so than the U.S.
Neil, before we let you go, it sounds like you're a little less bullish than you have been of late. Is that true?
Well, yeah, the data hasn't gone my way. How do you expect me to sound? You know, I mean, you have to be honest with yourself, right? So, but I will just say, I mean, I do think we're ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing and the Fed will be cutting. That is, I think, still the fundamental story.
And honestly, Neil, the data hasn't gone anyone's way because no one's been able to game this out. Right, Max, Neil, Dada, thank you so much for being with us. We really appreciate that. Just to note, AMH, we've been looking at 10-year yields falling on the heels of this report in particular. It seems like treasuries are still a haven bid, and we're seeing that kind of blow through the market.
We've been talking about the signals that are coming from the United States, coming from France, coming from Israel, actual tangible signals about where people should and should not be. This obviously has to do with some potential intel they have about what an Iranian strike would look like. And now our reporting is that it's going to happen within 48 hours. And this is why the markets are very concerned.
And we're seeing that kind of bled through the action. Right now, let's get you an update in stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Hakis. Yahaira.
Hi, Lisa. Apple is preparing to overhaul its entire Mac computer line with a new set of in-house processors designed to highlight AI. Sources say the tech giant is also nearing production of its next generation chip, the M4 processor. Bloomberg's Mark Gurman says Apple is aiming to release the updated Macs beginning late this year. Cathie Wood's ARK Investment Management announcing it holds a stake in OpenAI. It's the latest in a string of high-profile investments into the Silicon Valley darling, the biggest coming from Microsoft investing $13 billion. This comes as Cathie Wood's most famous vehicle, the ARK Innovation ETF, has been struggling. After years of gains, it stumbled this year due to a decline in Tesla's stock performance. And Bloomberg reporting that Israel is bracing for a potential direct attack from Iran in the coming days. People familiar with the matter saying it could come as soon as the next 48 hours. Those same sources telling Bloomberg the move has not yet been approved by Tehran's highest-ranking officials. The U.S. is preparing defenses and has moved additional military assets to the region and is stepping up diplomatic efforts as well. That's your Bloomberg Brief. Lisa?
Yahaira, thank you so much. As always, up next, the risk of higher for longer.
The risks are looking more tilted towards inflation stays even higher for longer than we've had, and the risks are looking that the Fed starts that easing cycle a bit later.
That's coming up next. Right now, in markets, you can see a bid into bonds on the heels of increasing geopolitical concerns. All of that coming up next. You're watching Bloomberg Surveillance.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back. We're dealing with the fact that we've got bank earnings on one hand speaking to strength. We see CPI pointing to strength and ongoing inflation pressures. And then you have geopolitical risks that are really fueling a rally in the commodity space pretty much across the board. When you do take a look at markets, crude back up north of 2% gains, $86.76 on the WTI. AMH has been talking about it. We will continue to break it down in terms of the latest from Israel. Under surveillance this morning, the risk of higher for longer.
Still have the Fed cutting in June, but I think the risks around that forecast have changed. The risks are looking more tilted towards inflation stays even higher for longer than we've had, and the risks are looking that the Fed starts that easing cycle a bit later. So we're holding on to those similar views, but I think the risks have definitely tilted in a different direction.
Here's the latest. Fed officials urging patience. New York Fed President John Williams signaling there's no need to cut in the, quote, very near term, whatever that means. And Richmond Fed President Tom Barkin saying it is smart to take our time. Bank of America's Jill Carey Hall writing, quote, we think the uncertainty overhang may challenge relative performance of the Russell 2000 for now, given higher for longer rate risks. Small is likely to lag large until later this year if and when we get more confidence in cuts. Jill Carey Hall joining us now. And Jill, this has been always a fascinating discussion. If we're getting this sort of cyclical boom, why are we not seeing it in the small caps? You're saying it's completely hinged on rate cuts, and if we don't get them, we're not going to get that rebound this year.
Yeah, and thanks for having me. I mean, we talked to a lot of investors, and I think there has been this year more optimism on small caps. We've seen that in the inflows that we track. But I think in all of the conversations that we have, investors have sort of been looking to the Fed as the next catalyst for why the Russell 2000 could move higher from here. Corporates in general, especially when you look at the S&P 500, they've locked in long-dated, low-rate debt. But for smaller companies within the Russell, about 40% of their debt is either short-term or floating rate. So, we estimate this could be a pretty significant hit to earnings over the next 5 years if rates were to stay high. Relative to, if we see cuts, then this becomes a less detrimental headwind.
Jill, forgive me for sort of the hypothetical here, but what does it take to get some sort of fuel to this particular sector? Is it just one rate cut? Is it just taking the prospect for even higher rates off the table? Or do we need to sort of see the beginning of a protracted rate cutting cycle that could bring some of these expenses, interest expenses, back into something similar to the past?
Right. I mean, I think, one cut isn't necessarily just going to solve the problem. I think, given how elevated rates are, our economists are now expecting that we'll see a cut in December. They had pushed that back from June, and 4 cuts next year. So I think if we get greater confidence that we're on a path to lower interest rates, so that when these companies do have a lot of debt coming due over 2025, 2026 and beyond, that refinancing won't be as big of an impact to earnings as it could be now if rates stayed at these levels. I think a lot of the macro positives for small caps still stand, the profits recovery. But, another risk there is that the profits recovery this year is very back-end loaded. Earnings are still going to be negative year over year this earnings season. The consensus is looking for small cap earnings to recover to about 30% year over year by the time we get to the fourth quarter. So we'll be paying a lot of attention to guidance this earnings season. So that could, potentially, if things do come through, set us up for a better year-end rally for small caps if we have confirmation that the back-end loaded earnings recovery is coming through, and if we have confirmation that, okay, inflation is cooling and the Fed is going to cut, which, is, as mentioned, is our economist's forecast now for December.
Jill, good morning. I'm looking at the breadth trade, and the Russell 2000 energy is at the top there, up over 10%, and tech. When you look at the commodity complex, we're talking about oil around this desk this morning, geopolitics with Anne-Marie, the warnings that are there. We're looking at oil, we're looking at copper, we're looking at some kind of a news cycle. Within the breadth narrative, within the Russell 2000, how do you play commodity strength, and will it endure?
Well, I think, the good news around the commodity-oriented sectors like energy and materials and industrials is that they are some of the sectors that have lower refinancing risk relative to sectors like real estate that could see a much bigger earnings hit. So I think within small caps, if you're an investor right now, you want to be selective, and some of these commodity-oriented sectors are one way to do that because they will benefit from higher commodity prices, manufacturing, GDP improving, but they're less sensitive to refinancing risk. So that's one area that we see as relatively better positioned within SMID, and we'd stick with higher quality stocks and stocks that don't have a lot of leverage or short-term or floating rate debt.
And then I pivot 180 and I look at the lags in the Russell 2000, and it is in the financials. We're getting information through from JPM, from Wells Fargo, from Citi, and it is about the net interest income. And that story incrementally under a bit of pressure, but is that more pressure to come in financials in the regional banks?
So within banks, we'd favor large over SMID banks for now. Obviously, the regionals have been challenged, and overall, this is a sector within the Russell that's sensitive to credit conditions and to the Fed. So that's an area that, even though it's ranked relatively well in our quant work, we're relatively cautious or more selective within right now. We'll see what all of the banks continue to say this earnings season, watching guidance pretty closely. U.S. corporates overall had guided relatively weakly in the last 3 months. Guidance usually is weaker at the start of the year, so we'll see if we see any improvement there. But in addition to financials, real estate is another one that we're more cautious on in small caps and does have more risk from refinancing.
Jill Carey Hall of Bank of America, thank you so much, as always, as we try to parse through the different cost currents and the whack-a-mole of narratives. So just to sort of recap today, we've gotten JP Morgan earnings, Wells Fargo, Citigroup kicked off. Basically, they did great. It's just that they didn't do quite as well as a lot of people had expected. You pointed, Menace, to a quote from JP Morgan. Just share it with us.
Jamie Dimon, increased dividend because our capital cup runneth over. I mean, it's the Don of Wall Street, the King of Wall Street, and just go, I've got it all.
Well, to a certain degree,
give it away.
They do have it all in terms of they've got a lot of cash coming in, but not quite as much as people thought, with the net interest income coming in below expectations, the net interest expense coming in above. We're also watching commodity prices really closely. Gold making a new all-time high, copper the highest since 2022, and then, of course, oil prices just continuing their march, Anne-Marie, and I gotta say, it's definitely causing a question of what this means in light of a strong dollar, in light of a lot of people talking about industrialization, and then what this means for inflation.
And you have to think we're going into a weekend that now is going to be tense, but a lot of geopolitical risk. Our reporting is that it could be as soon as 48 hours, we would see some sort of retaliation. And all morning, we've been pointing to the actual tangible actions. The United States, France are sending warning signals about individuals who are in Israel. The questions into the weekend: Iran wants to show capability. What does that mean? Because they told the Germans it would be, quote, appropriate. But this could just be us walking in with a bigger premium on oil come Monday morning.
And what's interesting is that there is a stronger bid into treasuries on the heels of some of the risk-off concerns. Coming up on Monday, PIMCO's Andrew Balls, Peter Scheer of Academy Securities, KBW CEO Tom Michaud, and New York Fed President John Williams. This was Bloomberg Surveillance.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City for our viewers worldwide, I'm Danny Berger in for Jonathan Farrow. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
Coming up, futures edging lower as the banks kick off earnings season. JP Morgan misses on loans, Citigroup topping profit estimates. And commodities keep rallying as gold hits another record high. Well, banks kicking off their earnings season with a whimper. JP Morgan disappoints and the market follows it. JP Morgan down some 3.5% so far this morning. Equities then also take a breather. A market that has been noted by the resilience of tech. Tech stocks have done extremely well. The NASDAQ just inches away from a record, but we back off now, again, perhaps because of the pessimism over the biggest bank and reporting loans that missed and deposits that didn't live up to expectations and expenses that were higher than estimated. A bid into bonds, perhaps some short covering ahead of a massive ramp up higher in yields, 30 basis points. Let's get into the macro story. Bloomberg's Michael McKee joins us now with a special guest. Mike.
Well, thank you very much. Susan Collins is the president of the Federal Reserve Bank of Boston, and she joins us now on Bloomberg Radio and television around the world. Thank you very much for getting up in this lovely rainy day here in New York and joining us.
Delighted to be here.
Let's start with the elephant in the room, CPI. It came in hotter than expected this past month, and now you have yourself and others suggesting we're not in any hurry to cut interest rates. Markets seem to be taking this as a policy turning point. Is it?
I wouldn't characterize it as a turning point. So you're absolutely right that the inflation numbers that came in this week were on what I would call the high end of what was expected. And if you look at the first quarter, certainly inflation is elevated compared to where it was as we ended 2023. At the same time, it doesn't change my baseline outlook that inflation will continue to come down with a healthy labor market. I just think it will take more time. And it's premature to tell whether the elevated numbers that we just saw are a bump along that path or something more concerning. So I don't see it as a significant turn, but important to continue to look at the data holistically and let the data tell us what's really going on.
Well, the markets, to go back to them, have priced out everything except maybe 1.5 rate cuts by the end of the year. Is it fair to say that, unlike them, you really don't know what you're going to do?
Well, policy is not on a preset path. And I think that's important. I think there's a maybe understandable desire to have us map out exactly what's going to happen. But in the current environment, what's really called for is patience, being very methodical, and looking at the whole constellation of information, not just focusing on one data reading or another one. And so what I would say is that we're continuing to form our outlook, recognizing that there are uncertainties and there are risks. So I call myself a realistic optimist in that sense, realistic about those risks and uncertainties, but still, for lots of reasons, very optimistic that we will see inflation come back down and that labor markets will remain healthy.
Well, how unconvinced are you that inflation is not going to come down as rapidly as you might have thought?
So I do think that we're going to have to be patient, and it may take more time. That is one of my takeaways from some of the data that we've seen. You know, at the same time, the data are mixed, Mike. So yes, the most recent inflation numbers have been elevated compared to what I might have hoped for. But at the same time, if you look at things like wage rates, so wage growth has been faster than it was pre-pandemic. But once you factor in the past price increases and, importantly, the productivity gains we've seen, the wage growth that we're seeing is consistent with that trajectory back down to 2% inflation. And I think that's good news for workers as well. But my point is that you need to look at the range of data and not focus too much on one piece, and take the time to really see what the takeaways should be.
Well, you said yesterday that the danger of over-tightening has kind of moved out of the picture at this point. Growth is strong, unemployment remains low, inflation is at least sticky, if nothing else. Why cut rates at all?
So I wouldn't say that that there is no risk of us waiting too long. I do think that it's two-sided. But to your point, I certainly do see more reason to focus on making sure that we don't start easing too quickly. We're resolute. I'm certainly resolute about that commitment to bring inflation back down to 2%. You know, I do see policy as being moderately restrictive at this point, and it, in my view, will be appropriate as we get closer to that trajectory. It will be appropriate to begin easing, but we're not there yet. So I don't think that we would indefinitely certainly want to stay where we are. My baseline would still have us starting to ease later this year, but when I see is likely to be later than I had been previously thinking.
I have to ask because everybody's going to bring up the question is, does the election interfere with timing?
Absolutely not. You know, as I've said a number of times, focusing holistically on the data is really what determines appropriate policy. And I have to say, there's enough of that to keep us very busy. So that is my focus, and that's the focus of the committee.
You mentioned policy is moderately restrictive. What tells you that? And how do you know what level of restrictiveness you need?
So in terms of the last piece, that's where watching the data comes from. Are we seeing the balance of performance that we're looking for over time? You know, certainly there's evidence of some restriction. We've seen housing market reactions. We've seen some increase in delinquencies. We've seen some declines in capital spending. And so there clearly is evidence in a variety of places. Labor markets are coming into better balance, and that's a really important one. At the same time, consumption and demand have remained perhaps surprisingly strong given where interest rates are and what we might have thought based on history. But you know, we've seen in a lot of contexts ways that the current context is somewhat different. So I would characterize where we are as policy is having a restrictive effect, which is what we want, but is perhaps moderately restrictive, and that calls, again, for patience and being methodical as we look at all of the data.
We've now got pricing basically for a December rate cut as markets move back and forth. But my nerdy economist friends have spent the last 2 days putting PPI and CPI into the PCE calculations, and everybody's saying PCE is going to come in much milder than both of those. If that's the case, can we say June might be back on the table?
So I don't want to speculate, again, not a preset path, and I think we have to wait to see what the data tell us. But to my earlier point, the data have been mixed, and CPI and PCE don't always move in lockstep. They certainly are very closely related. And so I think we have to wait and let the data tell us what's happening. And again, it's not just the PCE, although that is certainly the preferred measure that we are focusing on when we look at our 2% target. It's all of it and how it comes together collectively. So wage data will be important. When I look at the price data, I also want to disaggregate and look at what's happening to the different components, because the dynamics there are different, and that's informative for trying to understand where we might be going. Not just where we've been. The key question is, where are we going, and what's that outlook like? And trying to get to greater confidence before we change the policy stance.
Former St. Louis Fed President Jim Bullard once said during the aftermath of the financial crisis, whatever you think the right rate for the country is, this isn't it. Are you anxious to cut? Do you want to cut? Do we need a cut? Or can we live with rates at this level?
Well, in the near term, I don't see urgency. I had been a bit concerned earlier in the year, very early in the year, that there might be some signs of labor market fragility. I'm seeing much less reason for concern, but that again is why I see the risks as being two-sided. So I don't see urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, interest rates will be at lower levels. But exactly what that looks like, it's really premature to be too specific.
The data may be mixed, but what are CEOs in your district saying about both employment growth and also about whether or not they're still having to raise salaries and whether they're going to have to raise prices?
So, and we do have many conversations with people throughout our district, large firms, small firms, throughout New England. And what I'm hearing is a couple of things. One is quite a bit of optimism in terms of the economy's performance overall. I'm hearing information consistent with labor markets really coming into better balance, being easier to hire, except in a couple of sectors like healthcare, where that can still be quite a challenge. So, there are differences across different sectors and localities, but that firms have not been expecting the same kinds of wage increases that they had needed before to retain workers. Quit rates are way down, much less turnover. And that helps with productivity, right? Because if you are focused continually on having to fill those gaps because people are leaving, and then you have to train people to come up to speed, it's hard to maintain that productivity that firms really need. And that's part of the good productivity story that we've seen that has helped with economic growth and helped us to bring inflation down as much as we did in 2023, despite the fact that growth has continued to be so robust. So there's a strong supply side story there as well.
Well, productivity is one half of potential growth, and you're talking about productivity being good. A lot of argument these days that we're seeing more immigration than we're really accounting for, and that basically potential growth is higher than we thought it was. Do you agree with that?
So I certainly have seen increases in labor supply as being a key part of that supply improvement story that has certainly benefited the economy. And the labor supply increases have included immigration, and there's been a lot of work which has come from different people finding similar stories in terms of the increase in immigration playing a role. But we've also seen an increase in labor force participation, particularly in prime age workers, that was not anticipated, and really notably among prime age women, even though we know that the childcare challenges continue, and those are really quite stark. So there have been some surprising supply improvement news, and we'll have to see the extent to which those continue, but it's certainly been an important part of the story so far.
One last question for our money market desk friends, and that is, you had a staff briefing and a discussion of whether or not and when to taper quantitative tightening. The agreement, apparently, according to the minutes, was that you should announce it fairly soon. Can we expect something like that at the June meeting?
So no decisions were made. The minutes summarize the discussion that we had, and it really draws from lessons from the past period of quantitative tightening from 2017 to 2019. And some of the key lessons from that experience are the importance of doing the the tightening, in other words, runoff of the balance sheet, in a way that is smooth and does not cause stresses. That proverbial should be like watching paint dry, right? It shouldn't be unexpected. And so there was broad agreement that slowing the pace, which is currently about twice as fast as it had been in that earlier period, and doing so sooner to ensure that it continues to be quiet and orderly and passive in the background, broad agreement for that, and also to start that sooner, but no specific decisions have been made yet.
So we could get taper before we get a rate cut.
Those things I see them as being independent, so that could happen.
Susan Collins, thank you very much for joining us today here at Bloomberg on Bloomberg Radio and Television Worldwide. We'll send it back to you.
Michael McKee there with the Boston Fed President Susan Collins. Just a fantastic conversation, a lot covered there. Thank you so much. Okay, coming up in the program, big banks kick off earnings season.
We saw very healthy loan activity that will accelerate for the rest of the year, not only consumer, but really business.
And the results, a mixed bag this morning. We're going to break down the numbers next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
The first quarter sets the base for growth for the rest of this year, and I think the narrative is to be conservative. We certainly have a different economic backdrop as for growth. We saw very healthy loan activity that will accelerate for the rest of the year, not only consumer, but really business.
Big bank earnings is underway. JP Morgan moving lower. It missed estimates on loans. Citigroup rising on better than estimated first quarter profits. Let's get into the numbers here to break it down is Bloomberg's Sonali Basak. Hey, Sonali.
Danny, when we take a look at the numbers here, of course, we know that JP Morgan, what happened here is that they did not raise their guidance for net interest income. And you saw a little bit of a jump there when it came to their annual expense guidance here, partially due to the FDIC related assessments that many of the big banks are taking on, but also just in general, you do see expenses rising from compensation costs to technology and marketing. Now, what else is going on here? A little bit of caution. When you hear Jamie Dimon talking to analysts now about the consumer, what he says is they're fine. And it's interesting because when you take a look at both Citigroup and JP Morgan here, you do see still spending on cards and still average loan volumes decreasing, but a little bit of weakness when you compare some of those metrics to a quarter ago for some of those banks. So the big question here is what is going to drive net interest income forward at many of these big banks. Certainly JP Morgan is a bellwether. Going into the cycle, they were the most richly traded of those big banks, trading at almost 1.9 times their price to book value. And so it's not so surprising to see a little bit of cards being taken off the table here. The bigger question, Danny, is the read through to the rest of the banking system.
Yeah, we can certainly see in the price action this morning. Stocks down. Sonali, thank you so much. Bloomberg's Sonali Basak. Let's continue the conversation now with Stifel's Barry Bannister and Young-Yu Ma of BMO Wealth Management. Young-Yu, if we have here, as Sonali put it, the bellwether for banks, JP Morgan, a disappointment, shares off more than 3%. It is just one earnings, but what to you does this say about the pace and the market's ability and want to punish those who disappoint in this earnings season?
It's great to be here, Danny. I think the expectations are not high, but there's also probably not a lot of tolerance in this earnings season for misses. So I do think we're going to see some disappointments like this that come up. But I think that overall, given the expectations are not high, we will see some favorable action earnings performance, but we're not expecting a lot this quarter. We do think we'll see reacceleration of growth in the second half of the year, but I think right now probably warrants some patience.
Even if expectations aren't as high as they have been in the past, Barry, stocks have held up remarkably well in the face of higher yields, and a lot of that is down to the fact that the economy is strong, corporate profits can hold up. So given that expectation, how crucial is this earnings season?
Earnings are important, but what we find is that the stocks themselves respond to the second derivative, the change in the revisions rate. So while tech earnings are great, they have to be ever greater each time they report. On the other hand, some of the more cyclical industries are bottoming out in terms of their negative revisions. And as they turn up, the stock should turn up as well. We're seeing a slight rotation in the market, but right now, tech has been leading, obviously, since last October.
To that point, I mean, Dan Ives over at Wedbush, he is a tech bull, so this quote shouldn't be surprising. But in talking about the earnings, he said that we believe first quarter earnings will be a major positive catalyst for the tech sector and expect tech stocks to be up another 15% for the year, adding to the strong start in 2024. Young-Yu, we're already at a NASDAQ that is inches away from an all-time high. 15%, what do you make of that call?
Well, it is an end of the year call, so it's not necessarily related to this earnings season, but I do think that we'll still see momentum in some areas of tech spending. I think that as corporate spending accelerates in the second half of the year, I think a lot of that will go to technology. I think the data center theme that has been driving some of the markets or some of the stocks will continue as well. And also the idea that productivity growth will kick in eventually. Obviously, we've been seeing that coming from other areas, but productivity growth coming from tech spending could kick in maybe next year. So I think there's still some enthusiasm. I still think that we're not too deep into the technology cycle, that there's as much risk as there might otherwise be, even though we're hitting all-time highs. So I think that forecast is reasonable, but it could be a bumpy ride going forward. It's not necessarily going to be a straight line to that growth prospect.
Young-Yu, lucky for us, we've learned to live with bumpy rides over the past 4 years, so it'll feel normal if that's the case. Barry, I know you say you think that tech valuations will be challenged, but we hear from the likes of Wells Fargo who say, look, investors don't care as much about traditional valuation metrics anymore because of the promised land of AI and what that means for future potential. Is there any credence to that?
Well, valuation always matters. We have to discount the cash flows at some interest rate. And as the Fed has stood pat longer than expected, the yield curve is going to flatten one way or the other. either the long end, the 10-year yield, is going to go up to 5.25, or the short end has to come down maybe 50 to 75 basis points. So we're at that junction, that difficult period where valuation is a little challenged because risk-free returns do offer a somewhat more competitive option for investors. Valuation is something that we consider among other things, but it is challenging right now.
Young-Yu, what do you make of that argument that valuation metrics, traditional ones, aren't as important now because of AI and how it's reshaping how we think about these tech companies?
Well, again, I would echo or agree with what Barry said, that valuations definitely matter. But if we think about the momentum can last for a long time. And valuations, if you look at a model, tend to have more of a 3 to 5 year pull on equity markets. So it's not a good timing tool to use valuation. So as long as that theme remains robust, as long as we can get some of that second derivative that Barry was talking about to get increasing upward revisions, I think that will put still strength under the market and a bit under the market, but we are getting somewhat stretched in valuations. It does add an element of risk, especially if we get that long end of the yield curve rising. It does become a much more precarious market with valuations this high.
Don't fight the big mo. Barry, Young-Yu, stick around with us, much more to discuss. Coming up, it's the morning calls, and later we're going to be speaking with Isabel Casillas Guzman, administrator of the U.S. Small Business Administration. Small business optimism falls to an 11-year low. That's all ahead. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Challenging market for equities this morning. Nothing catastrophic, but down as much as 1% on the NASDAQ, which was just near all-time highs yesterday. So we give some of that back just moments away from the open. Let's get to some of your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, BNP downgrading VF Corp to neutral, seeing numerous headwinds and overly optimistic earning estimates. Next up, Citigroup slapping Sienna with its only sell rating, saying that AI benefits are likely still years away. And finally, Rosenblatt downgrading Arista Network to sell from buy, cutting shares by 2 notches, given its rich valuations and limited AI opportunities. Coming up, we get back to Barry Bannister and Young-Yu Ma.
think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly. We're Monzo. Give us a go.
See? I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Point move over the past 2 weeks. That is a 3 sigma event, so why not cover those shorts? It's also the geopolitics that's driving money into both the 10-year and NYMEX crude, up 2.5%. Again, Israel preparing for an imminent attack from Iran or its proxies in the next 48 hours. Meanwhile, euro sinks this morning. It is dollar bid across the board because of the same things I mentioned, but at the same time, an ECB which is holding steadfast and saying we are independent. We can indeed cut. We can cut in June. We heard from Stenaris this morning saying just that. Euro sinks at 106. Now, of course, the sector to watch this morning at the open, it is banks. It was a mixed bag for JP Morgan, Wells Fargo, and Citi, which reported results this morning. Simone Foxman has more. Simone.
Hey, Danny, well, this idea that the Fed might push off some of its rate cuts and that would be good for net interest income at banks appears to have gotten ahead of itself among investors, especially when you look at Wells Fargo and JP Morgan, where slight misses on their first quarter number, as well as some disappointing outlooks, appears to be having a weighing on the stocks this morning. Wells Fargo seeing net interest income below expectations, down 8.3% for a previous year, and it maintained its guidance that this metric is likely to be down 7 to 9% from 2023 for this fiscal year. The bank blaming higher funding costs and talking about deposit migration as consumers move to those higher yielding accounts. JP Morgan raking in $23.1 billion in net interest income in the first 3 months of 2024. That's up 11% from a year ago, but it kept its forecast, and that was disappointing for investors. Also raising its expense guidance just a touch of $1 billion to $91 billion, and that had a negative impact. The only positive today, and the bank trading higher by over 2%, is Citigroup, where net income in the first quarter came in slightly higher than expected, kept its revenue and expense outlook unchanged, and said that consumers are spending more on credit cards and carrying larger balances. That is good for Citibank. Jane Fraser also talking about the organizational simplification program that the bank has been on finally coming to a close, and that is, of course, the only major bank that is up in early trading, Danny.
Simone, thank you very much. So that's the price action. Let's get to the commentary. Shonali Basak joins us. She's been tuning into the calls. JP Morgan underway. Shonali, what have Diamond and Co. been saying?
A few things, and one, it has a lot to do with the strength of the U.S. consumer. It's interesting what Simone was saying. When you read through the banks and just how much they're growing, when you think about loans and deposits, there are questions about how consumers are spending their money. So how is that being answered is very important here. You have JP Morgan Chief Financial Officer Jeremy Barnum really talking about how incomes have largely been growing in line with inflation. However, there is a segment of the economy where that is not as much the case. Now, the big question then, Danny, becomes when will Main Street's struggles start to catch up to Wall Street? Certainly those Wall Street businesses have seen a lot of momentum, according to JP Morgan executives on this call. Certainly they do give you a note of caution here, but it really pairs well with what you're seeing from their underwriting results, blowing through expectations, positive commentary on the forward look on that pipeline for more investment in banking activity. The question of any weaknesses still remains on how weak the consumer really gets. Again, provisions were fine. The credit quality has been fine, but that slowdown in borrowing, there's an open question on how severe that gets.
Shonali, thank you so much. Shares down more than 3.5%. Stifel's Barry Bannister and Youngyu Ma of BMO Wealth Management are back with us. Barry, Shonali said there that for JP Morgan, it is still strength from a consumer who's willing to borrow, willing to spend. We saw the same from Citi. They are spending on credit cards. How much more space, how much more room does the consumer have to run?
Our view since last year has been that the economy has been recovering from a recession. We called it a pseudo-recession. If you think of a recession as income, production, sales, fixed investment, and employment, the first four actually went negative in real terms from 2022 to early 23. Only employment held up because we have a tight labor market, structurally short of labor relative to demand. So when you think about it in those terms, the consumer is fairly healthy. Wages are growing. Jobs demand exceeds available workers. And I don't think the consumer has much risk of rolling over here.
Barry, Jamie Dimon, though, he said it in his letter to shareholders. He said it in commentary today in his earnings, this idea that we are too far priced in for a soft landing, that markets think it'll be 70 to 80% likely we will get a soft landing. He thinks not so. He says the global landscape is unsettling, that there are terrible wars and violence, inflationary pressures, a lot of risks, which to him would indicate we're not pricing in enough of the recessionary outlook. You say we've already had a pseudo-recession. Does that mean, in your mind, that the recessionary risk is gone?
Well, I think a person like James Dimon has to think about 2025, 2026, and as an investor, we really look a little shorter term. The rest of this year, I don't see much weakness in the workers or the incomes. If I do think about what you're talking about, which is that could the consumer roll over on unemployment spiking and the Fed being too tight for too long, that is a risk next year. But inflation is notoriously late cycle. We're actually seeing the decline of inflation rates that you associate with the end point of a recession and the beginning of a recovery. And as a consequence, the inflation rate leveling out at a level more similar to pre-2008. In other words, the 10 years up to COVID, we were in essentially a deflationary depression ameliorated by Fed policy being super easy. That as the inflation comes down, we should be stabilizing here, and that's bullish for risk assets, which is why we've had a big rally.
Youngyu, what do you think about the consumer at this point? Would you agree with Barry that if the consumer is challenged, it's going to be a story of rolling over next year?
Well, I think most of the consumers are in good shape here. I think if you take about 2/3 of the consumers, they're in very good shape and at very little risk of rolling over. But I think if you take the bottom third of the socioeconomic classes, they're facing a lot of strains. They face strains from rental prices going up, from inflation straining budgets more than other consumers face. So I think it's more of a bifurcated consumer story rather than a uniform story. So I think that overall, if you look in aggregate, consumers will do very well this year and hold up well. The job market's in good shape. You'll see modest wage gains this year, and I don't see a big risk to spending in aggregate. Now, those companies that are focused on maybe that bottom half or bottom third of the socioeconomic spectrum could see greater challenges. But overall, I think consumer spending will hold up, the labor market will hold up, and the jobs picture will hold up.
Young Yu, I was speaking with Koku Agablua of SocGen earlier this morning, and he basically said that, look, with all those things holding up and rates remaining higher, risk can do completely fine because, one, company is refinanced in 2021, so the maturity wall is not a problem for them. At least it's not this year. And at the same time, they still have pricing power. They have excess cash. They've put that to work. They put that excess cash to work in money markets. And so if we are higher for longer, then why can't equities keep chugging along? I know we talked about momentum, but is there not just a fundamental level here, Young Yu, which equities are okay even if rates are higher and even if the yield curve starts to look different?
Well, we do think so. We do think equities can maintain the positive trajectory here, and even if the yield curve flattens out a bit. But we don't think that the equities would fare that well if inflation actually started to reaccelerate. If we get flat inflation, even if it flattens out around mid 3% here for the rest of the year, we think growth can stabilize the equity market and allow for a positive backdrop for equities overall. So we think there are various scenarios where equities can still do well. It's no longer a Goldilocks scenario where we're expecting multiple rate cuts along with sharply falling inflation and strong growth. But as long as we get level inflation and not damaging interest rate levels and growth kicks in, I do think that's still a positive backdrop for equities.
Well, I'd be remiss that part of the reason that risk isn't doing well this morning, that we're seeing a bid coming into bonds, a bid coming into gold, a bid coming into silver, is because fears over geopolitics. We had reporting not too long ago that Israel is preparing for an attack from Iran in the next, as soon as 48 hours, but certainly in the next few days. Barry, how far away are we from pricing in an expanded conflict? And how much of that pricing in do you want to do at this moment?
I would say that I would fade some of that geopolitical risk right now. You know, unfortunately, this is very much of a PR war, and Iran's position means that they don't have to overreact because they're doing fairly well so far in the PR war. So as a consequence, they're not going to overreact in terms of responding to the recent Israel actions. As far as the market goes, I fully expect a 5% pullback in the next month or two in the S&P 500, just from the overvaluation and a more realistic assessment of forward earnings growth potential. And I would collar that if I were an investor. I'd put a collar on that with options. But overall, we're more interested in things like the broadening out of the market, the recent strength in equal-weighted S&P relative to the S&P, and some of the bounces in value where the earnings revisions were deeply negative and now they're less negative than they used to be.
I'll tell you, certainly get a broadening out, at least into energy on a day like today. Oil up nearly 3% at its highest since October for Brent crude. Barry Young Yu, I'm afraid we're going to have to leave it there. Barry Bannister of Stifel and Young Yu Ma of BMO Wealth Management. Okay, let's get more into the tech story. Intel and AMD shares are falling after the Wall Street Journal reported that China has asked its telecom carriers to start phasing out foreign chips. Ed Ludlow has more. Hey, Ed.
Yeah, you can see downward pressure on Intel and AMD, and that's reflective of the proportion of their business that goes into the networking gear market in mainland China. China, as you said, is instructed, according to the Wall Street Journal's report, its two main telecoms carriers to look at their supply chain, look at their networks across mainland China and come up, this bit's the most interesting because it's granular according to the Journal report, come up with a timeline to replace the semiconductor and other components from domestic supply chain. So it's kind of a continuation of the story that we know about. Huawei, which has kind of been the domestic leader in telecoms networks anyway, has become a catalyst for saying, how are we going to onshore ourselves a lot of this supply chain? You know, they have themselves pivoted their business to a smartphone market. We know all about the Huawei Mate 60 Pro, but they also have a large part of their wider business that goes into networks, and they seem to be trying to work out, as a kind of leader in the field there, how they can do that. But we also know from the sort of parallel reporting about the semiconductors that have gone into their smartphones that this is a nascent effort where the technology is several generations behind the cutting edge of what US chip manufacturing is capable of. And in the context of telecoms networks in China, none of the names involved in the journal story replied to them. But these are quite significant moves lower. Intel and AMD both down in the 4% territory this Friday.
Yeah, a tough day across the board. Ed, thank you so much. Coming up on the program, small business optimism drops in the U.S.
The big mistake that was made in 2021 when people embraced the transitory narrative was they didn't listen to the companies. And the companies were clearly saying, we have inflationary pressures in the pipeline, we have pricing power, we're going to pass on that imported inflation, if you like, that was coming in.
SBA Administrator Isabel Casillas Guzman joins us next here on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This week, U.S. small business optimism dropped to a more than 11-year low in March. Sales expectations slumped, and inflationary pressures still remain in focus. Joining us now is Isabel Casillas Guzman, Administrator of the U.S. Small Business Administration. Isabel, thank you so much for joining. Great to see you in New York.
Same here. Thank you for having me.
So we have that data. Optimism at its worst since 2011. It's the 7th month decline out of 8. But the economy has surpassed expectations in 2023 and this year and is still growing. So why is there this disconnect in the data?
Yeah. What we see with small businesses, whom I visit constantly, I'm on the road quite extensively, talking to them, understanding what their opportunities are and the challenges. And there are challenges. They've had to pivot and adapt more than any other time in history. But we're seeing studies across the board also showing record optimism, and also showing Wall Street Journal's report just a couple weeks ago showed that 2/3 of businesses expect their revenues to rise in the next 12 months, and they saw a 2-year high in confidence amongst those small business CEOs. So there's 33 million small businesses in this country across multiple industries and geographies, and clearly they're picking up on some of the challenges in inflation, the interest rates, and that uncertainty there. But individually, they're seeing revenue growth opportunities. They're retaining their employees. Consumers are spending and walking in their doors with money in their pockets. So we're really trying to track and make sure that the SBA, that's here to help them with affordable capital, can fill those gaps and help them navigate the markets.
What about things like credit? Because credit conditions certainly have gotten tighter for small businesses. Is that where the optimism ends?
I don't think so. I mean, for SBA and its products, we've, in the Biden-Harris administration, released transformations to try to get more, especially small dollar loans, out there. And I think that's reflected in another data point, which is really interesting, and that's that 17.2 million new business applications have been filed since the start of the administration. It's the first, second, and third top years on record. And really, truly, each one of those is a sign of optimism in and of itself to jump in and start your business. But really making sure that they have the capital and the funding that they need. Yes, it's a challenging environment overall, and that's where SBA steps in to fill the market gaps.
What about just general indebtedness of companies? Because there had been this hope that we're going to get Fed rate cuts at some point this year. That seems to be pushed further down the line, if at all. Does it become a problem if we start to reach those points where loans are maturing, they need to refinance, and rates are still high?
100%. So capital's only one side of the equation. We really try to focus on those revenue growth opportunities and operational efficiencies through our networks that are on the ground to help these businesses, but as well with the historic investments in America. Those infrastructure build projects, those are contracts for small businesses who are then hiring employees who are spending locally. The Inflation Reduction Act and those credits and rebates. Well, the trades are going to be able to install those windows, install those HVACs. And so truly making sure that those businesses are connected is the priority right now in the Biden administration. SBA just yesterday released a new Invest in America digital hub, so small businesses could come in and check what opportunities, because they've got to focus on the revenues and the efficiencies.
Now, when it comes to raising prices, also in the most recent survey, it said 28% said that they'd raise prices compared to 3 months ago. That's the largest share since October. And plans to boost them further also increased. Does it almost seem like we're in the midst of another upswing in price rises rather than some sort of plateauing off?
Yeah, and I think that's what's the complex in these numbers. Our PPI came out showing a little bit more stability, right? But we know for the small businesses, it's an issue that they grapple with. They really, it's challenging to assess when they should increase their prices, when their marketing dollars are enough to really keep those customers coming through the doors at a higher price point. So that's one of the things that SBA tries to do with its advisor network. But that is definitely a challenge that small businesses are grappling with.
Well, one of the challenges that seems to have abated, and you need to correct me on this if I'm wrong, is the story about labor hoarding. This idea that companies were unwilling to fire people because they were so unsure whether they could hire again. Has that changed?
My understanding is quits are still low, and when I talk to small businesses, 100% they're retaining their employees. Oftentimes, small businesses give people their first job, which means they're doing a lot of training for our workforce here in America, and they do try to retain so that cost and inefficiency and turnover doesn't affect their business.
Is AI helping at all? I know all the big companies love to say, we're spending so much on AI, it's going to be the year of efficiency because we can do that. How much are small companies tapping into it?
Well, that was the story of the pandemic, the silver lining, that small businesses adopted technology at such high rates and really saw survival dependent on it. But they are adopting tools, including AI. It's not surprising, of course, that they started using it for marketing, writing their letters, et cetera, but also for customer service efficiency, chatbots, things of that nature. So they are diving in and trying to understand those tools that are available.
So coming around to where we started, because the data is mixed. You are seeing optimism. You are seeing them acting optimistically, hiring, ability to raise prices. Consumers are spending. But clearly some people out there are pessimistic if some of the surveys are reading this way. So when you meet with some of these companies, and they are the more pessimistically inclined type, what tend to be their top worries?
You know, definitely inflation has been a top issue over the last few years, as well as workforce issues, though. You know, it's still, people are worried to make sure that they can retain their employees. It's always top 5 amongst small businesses. You know, but in addition, you know, they want to make sure that they're positioning their business for growth. I've been very impressed by how the COVID relief dollars and the amount of money that we put in to help save those businesses, save competition in this country truly, has really been leveraged by those businesses to invest in equipment, invest in expansion.
Is there a sense that that's kind of running dry, though?
Those funds are, all of those programs are closed, of course.
Right.
But those investments are what is sustaining our economy as well. They invested in equipment. They invested in positioning their business to go after and compete. And that's what our nation needs.
Yeah, that growth has certainly shown up in the data, mixed as it might be. Isabel, thank you so much for joining this morning. Really appreciate your time. That's Isabel Casellas Guzman, Administrator of the U.S. Small Business Administration. Coming up, we're going to get over some of the market-moving events that you need to be watching in Friday's trade and throughout the next week. That's coming up in our Trading Diary. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, you know, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg. No banks are being spared from the sell-off. JP Morgan down 5% at its lowest in about a year. Citigroup, those gains turn into losses, down 0.7, 0.8, call it 0.9%. Wells Fargo, that's off 0.5% too. It is the fear over the JP Morgan miss, as well as geopolitics, that is weighing on risk this morning. Okay, let's get to your trading diary, what you need to be watching through next week. Fed speak this afternoon. We're going to get that from Bostic and Daly. U.S. Steel shareholders then voting on the Nippon Steel acquisition. Then results from Goldman Sachs on Monday, plus some fresh economic data, including U.S. retail sales. And then finally on Tuesday, we're going to get more bank earnings. Bank of America and Morgan Stanley post results. But so far, the word in is a difficult earnings season, down 5% for JP Morgan. This was the countdown to the open. This is Bloomberg.
top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. I'm Alex Steele. Paul Sweeney is on a sojourn to Duke University, but luckily I have Molly Smith. She heads up our U.S. economy team right here in the U.S. We are live from Interactive Broker Studio right here in Midtown Manhattan. You can also check us streaming on YouTube. We're going to break down all the data that's coming out. UMISH just coming out right now. We're also going to break down earnings, what's going on with banks, and also geopolitics and oil. It's a busy day, and it is a safety trade kind of day. We're going to get all our top analysts from Bloomberg Intelligence to come on and tell us what to do as we head into the weekend. But for now, we're going to get to Business Flash with Lisa Mateo pulling what? Triple
I don't even
duty?
know it anymore.
Hour 4? Something like that.
We're going strong. Coffee works wonders. Good morning, everybody. Market Drivers brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at IBKR/RIA. All right, stocks taking a hit right now. We have the NASDAQ down about 0.6%. Same for the S&P 500. The Dow is down about 0.5%. And of course, this is all as big banks open their books. I want to hit two of them right now. We'll hit JP Morgan Chase. They're down about 4%. Outlook for full year net interest income, that missed expectations. And then we'll go to Citigroup. They're down about 0.1% right now. First quarter profit topped estimates. We'll go over to the 2-year yield at 4.89%, down about 6 basis points. The 10-year yield at 4.51%, and that's down about 8 basis points. We have the latest economic data, PPI, CPI. That's been changing views on interest rates. We have economists at Deutsche Bank, Bank of America saying the Fed's going to ease policy just once this year in December. And then you have the Fed, Susan Collins, says she sees no urgency to cut rates in the near term. Today, we learned a few things. We learned import prices rose about 0.5% in March. A big rise in that, no surprise, a rise in fuel prices. Yeah, drove that headline figure. But when you take it out of the picture, consumer. Import prices were pretty much flat. What about sentiment? That just came in right now. April consumer sentiment fell to 77.9. That's according to the University of Michigan, and that was in line with estimates. That is your Bloomberg Business Flash. Alex and Molly.
All right, thanks so much, Lisa. Really appreciate it. Molly Smith in with me for the next 2 hours. I've never anchored with you before, but I'm really looking forward to it.
Yeah, we've got such a treat. I'm so excited, especially our first guest coming right out of the University of Michigan, where I normally would be writing up this report, but we get to talk to Joanne Chu herself today.
That's why we love this. So not only do we give you all the great analysts, but we also bring you instant analysis with the data that crosses at the 10 o'clock hour. So the University of Michigan sentiment coming in a bit lighter. Current conditions also a bit lighter. Expectations, get where I'm going, a bit lighter. And 1 year and 5 to 10 year inflation expectations, guess what? A bit higher. So let's get more to it with Joanne Chu. She heads up all the data here from University of Michigan. She is University of Michigan Surveys of Consumer Director. All right, Joanne, great to chat with you. What did you make? What's your takeaway?
Essentially, consumers didn't really see any sort of changes in the economy, not just in this month, but actually since January. Their income expectations, labor market expectations, their views of their personal finances, everything has been remarkably stable since January. The one exception is this month, there was a slight uptick in inflation expectations. Consistent with what we saw in the CPI report earlier this week, consumers have internalized that information and bumped up their expectations for inflation accordingly.
Joanne, how much of this is due to rising gasoline prices versus broader inflation?
It is partially to do with higher gas prices, but typically gas prices tend to affect sentiment more than they affect inflation expectations alone. So, I think consumers are very much reserving judgment about the medium and longer term trajectory of the economy. A lot of them are mentioning uncertainty over the election. So they are taking some signal from gas prices, but, they have noticed that this inflation slowdown has decelerated, and they're not terribly pleased with the pace of disinflation.
Walk us through the great stuff that you guys do of Democrats versus Republicans. Is the sentiment sort of on the same wavelength for both?
It's a little too early to tell at mid-month. We'll know more at the end of the month. But what we are seeing so far is that, as usual, consumers who belong to the party that's in the White House tend to have higher levels of sentiment than consumers in the party not in the White House. So right now, Democrats have higher levels of sentiment than Republicans. Independents are right in the middle. And for all of these groups, there haven't been that many changes since January. It's been 4 months of remarkable stability in how people view the economy.
So we've seen generally, when you're looking along party lines, that there have been, for the most part, sentiment among Democrats and Republicans has been generally rising in recent months, while independents have really been lagging a lot. Can you speak to how that, what that means for the mindset of somebody who perhaps is an undecided voter, if that's like how you would make that takeaway?
It's a little bit hard to say because even among independents, there are some that lean Republican and some that lean Democrat. So it's really hard to say from our data how many people are actually undecided at this point. Overall, independents have been in the middle. The rising tide that we saw towards the end of 2023, in which sentiment surged, that was something we saw, across all three political groups. And across all three political groups, they're all, I wouldn't say holding their breath, but they are really reserving judgment and waiting for the election at the end of this year because they do see that a lot of the economy is going to hinge on that.
Although, Molly, did we see that in the CPI report, butter prices are down relative basis, right? But pastries and cereals, so I don't know, your breakfast croissants that you're going to make, it could be worse.
I mean, chicken prices were really high, though. I don't know if you saw that. The poultry market, though, these days.
That's crazy. My husband makes too much chicken. I'm like, stop with the chicken. And
needs
now
more
I can
veg.
and now I can tell him,
this is why. Look at the CPI.
Exactly.
Get out there.
Before I let you go, Joanne, if I'm the Fed and I'm looking at this, is there a takeaway for me? Is there a signal?
I think the signal that policymakers should take from this is that not only has, did the CPI come in hot earlier this week, but consumers have incorporated that into their expectations for the future. They are expecting a little bit more inflation in the year in the next 5 years than they were expecting just last month. So that's definitely not the trend that that you want to see. And so consumers have noticed.
All right, Joanne, thanks a lot. We really appreciate it. It's always good to get their perspective. Instant analysis, right? We get the data, we get Joanne, we have you covered on all fronts. Joanne Shu, University of Michigan Surveys of Consumer Director. Was that cool for you?
Oh my God, yeah.
Super fun? Okay.
I feel like we just got to interview a superstar.
Oh, nice. Okay, great.
What a great start to Friday.
Okay, we like to make Molly Smith happy here.
Next we're going to bring in a tennis star. Then you'll really see me just fly off the seat.
Right, because you're like a pro tennis player?
I mean, maybe on the Bloomberg tennis team, but, no one's looking for breaking points there.
Fair enough. Okay, let's get to some breaking news. According to The Information, StubHub is looking to go public by the late summer. This is according to people familiar with the matter. This would be another big internet initial public offering after Reddit's IPO last month. StubHub apparently has more than $2 billion in debt, a lot, many times its estimated profits, but nonetheless, that the headline just breaking from The Information, StubHub seeks to go public by late summer. Let's get a quick check-in here on what's happening in overall markets. Vincent Signorella, Bloomberg macro strategist, joins us now. Hey, Vince, to me, this looks like a straight-up safe haven bid today in the market. What do you think?
Yeah, very much so. We're seeing another sell-off in equities. They're just catching a whiff of what you guys were just talking about, the UMISH inflation expectations kicking higher. They're down about 300 or so on the Dow. I think we would have seen a big sell-off in treasuries with that inflation numbers coming from UMISH, except for what you just mentioned. The tension in the Middle East is keeping a bid under that market. I don't know how long that's going to last. I would look at this, if I were a long-term fixed income trader, as an opportunity to fade this rally in treasuries, as inflation expectations are more likely than not going to see higher yields down the road once we get past and hopefully don't have what Iran has promised as escalating tensions in the Middle East in the next few days.
And we just had a crazy week of economic data here. Obviously, the CPI that you just mentioned really just threw everyone for a real doozy on Wednesday. A little bit of relief with PPI yesterday. What's the next big catalyst for the rates market here, Vince?
I think retail sales next week, we'll see how the consumer's holding up. And that'll be, I think, a key figure. If we, a lot of people keep saying inflation's not that big a deal because we've seen an increase in wages, and that expectation would have to then carry through into retail sales and spending continue. If we see some sort of a fall off in retail sales, you kind of get the worst of two evils, where you're seeing rising inflation and slower growth. Something the Fed would absolutely not be able to tolerate, and frankly, I don't know how they would even deal with that. That's something we haven't seen in a real sense until the 70s. We're seeing a strong dollar as well, which is, I think, going to be the widowmaker trade of this year. Every year we start the year with people saying, sell the dollar, it's going to go down, and every year for the last many years, that's been something of an opposite story. But the key is, like we saw this morning, the earnings season's not starting well. If retail sales back off and the consumer isn't going to support that, this equity sell-off is just going to continue. And the rate cuts that the expectations folks are talking about, without something like a major rollover in consumer spending and economic growth, I just don't see a reason for those rate cuts at all, to be honest.
Yeah, Vince, love it, appreciate it. Thank you, Vincent Signorella, Bloomberg macro strategist, joining us there. So let's get to the other part of the market today, and that's what's happening with banks. So JP Morgan is down by almost 5%, Wells Fargo is up by 0.1%, and Citigroup now down by about 0.3%. Granted, it's a tough tape. It's definitely sort of going to a safe haven, flight to safety. You don't want to take on that equity risk into the weekend. But nonetheless, let's dig through what we learned here. There is literally no other person that you want to talk to but Allison Williams, Bloomberg Intelligence, senior analyst, global banks and asset managers. She joins us now. All right, Allison, okay, two questions. Is there a macro takeaway for me? And if not, what is the takeaway?
So there is a macro takeaway, which is positive, which is the fact that credit costs are coming in much better than expected, and that's because the reserve builds are either coming in lower than expected, such as at Citigroup, and we actually got releases at JP Morgan and Wells Fargo.
Meaning things may not be as bad as maybe
Meaning
we
that
thought.
their outlook, right? So the reserves are really all about what they expect for losses. They're meant to look at losses over the life of the loan. What we've seen over the past, year or so is just a change, I think, in the weighting of the scenario. So moving more towards an expectation for the Goldilocks type of scenario versus the expectations for a recession. JP Morgan is trading down today clearly on the net interest income guidance disappointment. I would make the point that they have beat net interest income and raised guidance for several quarters in a row. They kept their overall guidance for net interest income steady, and their core net interest income, which we think is the metric to focus on, that's actually better. So we think that's a good thing, but still might not have been, enough for some of the bullish investors. But we do think that they could just be saving all the good stuff for their investor day. So they have investor day coming up in May.
One of those under promise, over deliver.
Yes, and
we love to see that in the corporate world.
Well, and they will be, they will be telling their full story at Investor Day. We expect to hear more about, their expectations for returns, their expectations for capital, their expectations for costs. The cost did come in higher at JP Morgan, but that was really due to the FDIC special assessment, which is something we're expecting. So we think, that's sort of fine.
That's just a one-off
as well too. Yeah. So we would not make too much out of that. I mean, the bigger banks, the more deposits you have, the more you're going to have to pay. And so JP Morgan, all the other banks are making those payments. We saw those charges at Wells and Citi as well.
So with this net interest income, I mean, this really what is going to be like the big item to look for in the bank earnings. We had a great story out earlier this week talking about that, how much this relates to the outlook for the Fed path and this net interest income. For you guys who aren't as familiar with bank balance sheets like myself, this is how we describe the difference between what banks earn on assets and what they pay on debts. So it's in their interest to see interest rates stay high, and it makes that net interest income go higher. So you're telling us then, Allison, that the guidance that they've still been doing this under promise, hopefully later over deliver situation, and that the guidance has still been pretty weak?
Well, I think, keep in mind that we're looking at guidance for the year. Mm-hmm. And I think while net interest income was the focus coming into the quarter, like the credit costs, I think are really kind of the surprise of the quarter, if you will, like sort of the key takeaway coming out of the quarter. So, net interest income, everyone can see that the last time these banks reported, there were, 6 to 7 cuts expected. As of today, there's 3. And so I think investors were looking for that change, but keep in mind, a lot of those cuts were weighted in the second half.
Yeah.
Again, we saw how quickly things changed the last 3 months, so we don't think it's crazy. In fact, we think it's conservative and the right thing to do, that these banks would be conservative and wait before they change around those expectations, right? Instead of just jumping things all over the place. So I think it's right to be conservative. It doesn't mean that we're not going to get a change. And really, like as pointed out by Citigroup, the big change is going to be to next year. It's really 2025 that as we get the changes in these expectations, that's where it'll play out.
Expectations for the Fed, you mean?
Expectations for the Fed, yes.
Okay.
I should have clarified that. And, so keep in mind that most of the banks are positioned for higher rates. And I think that's really what investors are watching. The other side of that are the, trends in deposit pricing. If we do get lower rates, we could get a benefit in terms of the deposit pricing.
Because they raised it so much before. I'm kidding, because they didn't do that at all. I mean, I think my Citi account is like 0.89%. Please.
Right, and so the interesting dynamic, right, is that rates went up. Immediately, they adjusted the prices to the loans, but on the deposit side, they were slower to adjust, and in part, we were at 0% for a long time. The pandemic, they were making no money. So in part, things had to balance out a little bit.
Sure.
But, once you get to a certain point, which is where we are now, you expect that to sort of catch up. And so, that 0.89 is up from 0, Alex. Gosh, I mean, aren't you so excited?
But,
but the thing is, like, if rates keep, stay where they are or keep going up, you're going to say, hey, where, show me the money, right?
Oh, I am. And don't think that I didn't miss when Marcus cut their high yield savings rate by 10 basis points on like last week. I was like, you got to be kidding me. Anyway, Allison, thanks very much. Allison Williams, she has all of our bank coverage, credit card coverage, asset management coverage here for Bloomberg Intelligence, senior banks analyst. We very much appreciate that. I gotta say, I was very stunned. I mean, I granted 10 basis points, but like...
Oh no, that's a big difference when you've been just clipping this away, sitting here earning what, 5+% for basically holding a treasury.
Thank you.
Yes.
Thank
that
you for
hurts.
validating my feelings, Molly Smith. I very much appreciate that. All right, equities trading heavy around the lows of the session. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Right now, stocks are falling. We have the NASDAQ down about 0.8%. The Dow and the S&P 500 down about 0.7%. The two-year yield at 4.88%. That's down about 7 basis points. The 10-year yield at 4.49%, and that's down about 9 basis points. To commodities, we have to go there. Brent crude hits the highest since October. That's on the conflict in the Middle East right now. Brent crude at $91 a barrel. And then gold also hit a record. We have COMEX gold above 2,400 right now. Spot gold at 2,413. Silver hit the highest in more than 3 years, and copper rises to the highest level since June of 2022. To currencies, just have to point out the pound drops below 125, the lowest since November. And then we have the euro that dropped to the weakest level against the dollar in 5 months. All right, let's get to the kickoff of earnings. We talked about JP Morgan, Citigroup. We'll check in with Wells Fargo right now. They're up about 0.1%. We have BlackRock. They're down about 1%. And then finally, State Street is down about 2%. Also this, U.S. Steel, they're down 0.1%. U.S. Steel and Nippon Steel deliberating that decision on to formally push back the time frame they expect to close their $14 billion deal. That's according to sources. That is your Bloomberg Business Flash. Alex and Molly.
All right, thank you so much, Lisa, for that. Yeah, U.S. Steel, the union workers were supposed to be voting on that deal today, so maybe pushing that back. Maybe that means that negotiations are moving and there's something to talk about. So we'll see. We will keep our eyes on that. So definitely a safe haven bid into the market, but we did learn a lot about the economy this week. The latest, of course, with the UMich data with expectations and current conditions coming in light, while those inflation expectation numbers were revised higher. So let's get the broader read here with Hassam Naji. He is CEO of Marcus and Millichap. He joins us now in the Interactive Broker Studio right here in Manhattan. I bet you miss California right now, huh?
Good morning, but I love being in New York.
You do? Okay, good. Even the rain
here.
and the whole thing? Okay. What did we learn this week about where the U.S. economy is?
I was actually attending the Urban Land Institute conference, which is a very important trade group for commercial real estate. There were literally thousands of our clients here over the last several days. Everybody's very enthusiastic about the economy, the fact that jobs are coming in hotter than expected, and even consumer strength is coming in hotter than expected, and even some of the inflation readings that are pushing the Fed out in terms of their timing is all good news for demand for various types of space, whether it's shopping centers, even office buildings are starting to see more of a recovery, apartment buildings, self-storage, even mobile home parks and student housing. So the demand side of the equation is a reason for optimism. The fact that the interest rate spikes have really impacted valuations, and the fact that banks have pulled back from lending are creating huge challenges on the transactional side of the equation, both in underwriting what the value should be and in securing financing. Commercial real estate is very interest rate sensitive, of course. That's where the concerns are.
Well, tell us about your clients and if what kind of challenges they're facing right now. If this is a really tough environment to get a loan right now, perhaps to be expanding, and just generally how they view the landscape as well.
I would say the biggest challenge is securing financing, and the proceeds from a lender were as high as 65 or 70% of the price of an acquisition. That's down to maybe 50%. So not only have interest rates gone up, the lender's willingness to finance more of the acquisition has declined, and that is creating a huge challenge. But more than anything else now that we're 2 years into this tightening cycle, we're starting to see clients recognize the price adjustments that have already occurred becoming an opportunity. Blackstone had declared the bottom about a month ago. Just a few days ago, they announced a $10 billion acquisition of a publicly traded REIT that they're taking private. Those kinds of signals really jive with what we're hearing from institutional and private clients on the prices being much lower than replacement cost. It's getting more expensive and more difficult to add new space of any type of product. And the replacement cost equation now makes commercial real estate a lot more attractive than it was just 2 years ago.
So then for the broader macro read on rates, does it matter then that rates haven't been cut? Does it matter that we're at, almost 5% on the 2-year, or is it just it just needed time to readjust to a higher for longer world?
It's a combination of both.
Okay.
Interest rates matter a lot. A quarter basis point, 50 basis point on your financing rate makes a big difference, especially on the smaller price points for private investors, which make up the bulk of the market, by the way. 80% of the market in the commercial real estate world is priced under $10 million. So those micro cap private client deals are very interest rate sensitive, as are the larger acquisitions, of course. But time has brought the price adjustments. A little bit more time will bring more price adjustments. And the Fed's lowering, whether it's once or twice isn't so much the mathematical solution people are looking for, it's the psychological confirmation that the tightening is over. We're going to start to get out of a restrictive zone, which is where the Fed has had us. I don't think they want to keep us in that restrictive zone a minute longer than they have to, but unfortunately, inflation is proving to be sticky, and the timeline keeps getting pushed out.
So coming back to replacement costs for just a minute here, I just went through buying a home.
Oh, you
So-
did?
I
Congratulations.
Yes, thank you so much.
What was your 30-year rate?
Oh, it was thankfully no mortgage on this, but
Oh,
there
yay.
is.
Congratulations.
Thank you so much.
That's
but
amazing.
when I was going through this process, so obviously this is on the residential side, but when I think of replacement costs, I'm just thinking of, man, going through getting an insurance policy and how much more expensive that was, thinking of all of how these costs are rising for both the material and labors. God forbid you should ever need this policy to help you. So tell us if that's also what you're seeing on the commercial side in terms of insuring some of these properties too.
That is undoubtedly, next to interest rates, the second most talked about issue is insurance across all property types, especially in regions that are more sensitive to natural disasters.
Yep.
Florida, for example, California. But across the board, insurance is skyrocketed. So on top of the interest rate factor and the increased cost of debt, you have inflationary operating costs and then insurance. So that's another challenge that the industry is facing. But I have to tell you, your strategy of paying all cash
Oh, brilliant.
and then putting financing on it later is very commonly used, especially by private investors that now see opportunity to buy what they want to buy and at the right price point, and then figure out the financing a little bit down the road. And we're seeing a lot of short-term financing solutions with astute investors that know that interest rates are going to come in at some point, and they don't want to sort of tie up their financing for much longer than they have to in order to take advantage of rates coming in at some point.
I suppose I am an astute investor then, in some way.
She's like, I didn't mean it like that, but okay, that sounds
It
great.
seems that you are.
No, but then yes, absolutely. Like, because then you have it free clear, right? And then when you need it, you have the ability to, and you can wait until we get down to 3 if you need.
Yeah, more hope. Again, this idea being that this will be an if rather than, or rather, sorry, it's going to be a question of when rather than an if.
Right.
Yes, so that's got to be something that you guys are looking at now too, of just like counting, biding your time of like, is it 2 cuts this year? Is it 3, 1, 0?
Again,
Is it this year? Is it next?
We expect 2 cuts.
Okay.
Even back in October, November of last year, when people were talking about 4 to 6 cuts, we never bought into that. The economy was too strong, inflation was too high, and so far that has proven to be accurate. But again, it's more of a psychological factor than it is a mathematical factor. What I think is really important to also keep in mind is that as we move forward into the next cycle, the tax advantages of owning commercial real estate, especially through direct ownership, don't get talked about enough. As an asset class, not only do you have an adjusting price point, you have a strong economy. Hopefully, the economy won't get so weak to justify even more of a sort of a reduction in rates than we expect. The fact that the economy is holding up is good news. And you combine a strong economy with the tax benefits and adjusted pricing, I think the next cycle is actually going to be pretty robust for commercial real estate.
Before I let you go, Wells Fargo also had lower commercial real estate charge-offs, predominantly in the office portfolio that they had. So do we feel really confident that we've hit the bottom?
I absolutely feel strongly that we've hit the bottom.
And how long do we kind of bounce along there?
That depends on the psychological factor of the Fed and how well the economy holds up. But I will say that there is more room to go on the price adjustments. We're saying anything that's basically readjusted in valuations since March of 2022 by anywhere from 15% on the low end, 25% on the higher end, getting multiple offers from very aggressive buyers. There's record capital on the sideline waiting to come back into the market. And as we get clarity on the distress not being a wave of fire sales by banks, which I don't anticipate will happen, that's another reason why capital will come back into the marketplace.
Time. They just need time. I feel like we heard a lot about that over the last few years. And we're like, no, we're journalists. We need data now. But we just went needing the time for that. All right. Thank you so much. We really appreciate it.
Thanks for having me.
Hassam Naji joining us. He's CEO of Marcus & Millichap. Now, you cover the economy, right?
Yeah, as an aside.
As an aside, what do you guys make of the commercial real estate market right now? What are you guys talking about?
You know, I think what Hassan was just telling us is actually a lot, very similar in some ways to what you see in the residential market, in that, like, there's still a lot of multiple offer situations happening, and that is pushing up prices in certain ends of the market, and that there are a lot of people who have been waiting to buy, and that this interest rate environment has obviously been really challenging for people looking to get financing, but they're also settling into this acceptance that this is the level that rates are going to be at for the time being, that we're not going to put off this purchase any longer, that, you know, life happens, that maybe we need to move, there's a, you know, a change in our family or a job, and that it's time that we're going to bite the bullet. And rates are now at 7%. It's not great, but it's better than 8%.
Right. Well, also, it's like, if you're not going to get that cut in March, you're going to wait then to July, and then now do you have to wait till September? And what if we don't get a cut at all? And then you're waiting like a whole other year.
Exactly. It just pushes these decisions off into infinity. So.
Yeah. I have been noticing. I like researching Zillow and StreetEasy. A lot more coming up. All right, Michael Barr, World National News. Hey, Michael.
Hey, Alex, Molly, Lisa. Israel is bracing for a direct and unprecedented attack by Iran on government targets as soon as tomorrow, a move that has the potential to trigger an all-out regional war. According to people familiar with Western intelligence assessments, the assault from Iranian soil has emerged as one of the main scenarios. The chairman of the Joint Chiefs of Staff, General C.Q. Brown Jr., on CBS Mornings said the military is working with Israel to increase humanitarian aid to Gaza by way of a sea route, including a pier that is now under construction.
What we want to do is, as we engage with the Israelis, is particularly when you're operating in a urban area, to avoid civilian casualties, but at the same time bring in the humanitarian aid. We're on track to bring in the capability. One of the things we're also, again, focused on is the protection of the pier as it comes in.
Iran has vowed revenge for last week's Syrian embassy assault. The U.S. spy community is waiting to hear if Congress will renew a portion of the Foreign Intelligence Surveillance Act. The House may vote later today on renewing Section 702 of FISA. U.S. intelligence officials call 702 crucial to doing their jobs because it gives them the power to collect communications of non-Americans located outside the country without a warrant. FBI Director Christopher Wray pleaded with the congressional panel to end the stalemate in the Appropriations Committee and allow it to reach the House floor for a vote.
It helps us find out who these terrorists are working with and what they're targeting, and it's what we need to stop them before they kill Americans.
Critics say the surveillance program is a violation of civil liberties, and Americans who might get caught up in the spy scheme deserve privacy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Some more economic data out this morning. Import prices rose nearly 0.5% in March. Now, rising fuel prices, that drove that headline figure higher. When you take that out of the picture, the import prices were flat. We also learned U.S. consumer sentiment. That declined in early April by more than predicted. The University of Michigan's index, well, it dropped to 77.9 from last month's 79.4, which was the highest since mid-2021. We also had some more Fed speak. The Fed's Susan Collins said she sees no urgency to cut rates in the near term. Then you add to that investors looking over reports from big banks, Israel bracing for a possible attack from Iran. You get stocks that are lower, and that's what we have. The NASDAQ down more than 1%. S&P 500 down 1%. We have the Dow down about 0.8%. The two-year yield at 4.87%. That's down about 8 basis points. The 10-year yield at 4.49%, and that's down about 9 basis points. We're keeping an eye on Amazon shares because the company is trading at a record. It's actually the last of the 5 biggest U.S. tech firms to reach an all-time high in that rebound from post-pandemic sell-off. Right now, Amazon shares, they're down about 1%, though. And to fast food, listen to this, California's wage hike for fast food workers pushing McDonald's locations to bring back a fan favorite, yes, to boost traffic. We're talking about bagel sandwiches. There you go. That is your Bloomberg Business Flash. Alex and Molly.
Wait, they're doing the bagel because of wage hikes?
Because they want people to come back, so they have to boost traffic. Since they're paying their workers more, they need to make more money, so they're figuring a bagel sandwich will do it.
You know, this is what we worry about
Just
in
in
economics
California.
called the wage price spiral.
Yeah, no, seriously. But does it cost them more to make a bagel sandwich? Like, I wonder what their
Or
output
boosting
is.
your
They're
margins.
they're figuring get more people in the door. That's all
Right,
it
it's
counts,
about
because while they're
volume, not
there,
about
they'll
pricing.
buy more.
Interesting. Lisa, thank you very much. I'm Alex Steele alongside Molly Smith, in for Paul Sweeney. He is somewhere around Duke University right now. That's where Paul is. You're listening to Bloomberg Intelligence Radio, where we bring you all the top analysts proving all our top analysis. They cover 2,000 companies, 130 industries all around the world, and we're going to bring all of that for you live. We also tap our newsroom for the amazing information, sourcing, storytelling that they provide. And the latest to do so will be Alex Longley, Bloomberg oil trader reporter, is standing by to talk about what's going on with oil. So Brent is up by over 2%. WTI crude up 3% almost. Brent is going to be the thing you look at if you're looking at international geopolitical risk. WTI will track it, but it's really a little bit lower because that's more of a domestic pricing. I'll explain that for Molly Smith. She asked.
So I did.
She did. She asked. So that's why, I feel
So
like
if I wanted to know, surely someone in the audience wants
That's
to
what
know.
I was thinking. That's what I was thinking.
A voice for the people.
That's my Alex Blaine. Let's get to the next Alex Blaine. Alex, talk us through the recent spike and why we're seeing it.
It's been a sort of a three-pronged rally. Obviously, today there's extremely high geopolitical risk given the news surrounding Israel and Iran. And that's been the kind of final catalyst that's pushed Brent crude, as you said before, above $90 a barrel. But this also was a broader rally in the making. We've had stronger than expected demand in the first quarter, according to the traders, although we had a report from the International Energy Agency today, which cast that into slight doubt. We've had tighter supplies as OPEC keeps its production relatively low, reduced by 2 million barrels a day through until June. And we also have globally a reflation trade in which some traders are getting back into the oil market who left as they were looking for portfolio hedges. So when you throw in the geopolitical tumult on top of that, you have an oil price that's heading well into the 90s a barrel, and in which traders are kind of afraid to short the market heading into the weekend, and that's why we get rallies like we're seeing today.
Is the concern that this is going to be, like, that there's more upside risk here, that we're going to stay at this 90-ish level? I mean, what's the kind of sentiment right now about the outlook for oil prices?
Yeah, and we've just had a big commodities conference here in Europe with all the kind of top traders from the independent trading houses, so Vitol, Trafigura, Gunvor. And one of the interesting themes coming away from that wasn't so much the more bullish outlook per se, which I think is everyone's kind of become accustomed to very quickly, but it's actually the speed with which that's changed. We had IP Week here in London in February, and everyone was sort of relatively downbeat, was fairly confident that prices would remain range bound. And in a little more than 6 weeks since then, this has become a rampantly bullish market. we had Vitol talking this week about a kind of $80 to $100 range. As prices move higher, you will continue to run into the types of issues you do when you have high oil prices, things like demand destruction, things like incentivizing US suppliers to produce more, or US producers to produce more, I should say, and also slippage from within OPEC itself. That said, there's also not much conviction that if prices were to fall, which feels very unlikely today, that they're going to fall very far because OPEC producers are willing to protect that downside.
Well, exactly. I have to think, at what point do the Saudis use that spare capacity? So they have a lot of it. They've been unwilling to use it. Is it like a $95 thing? Because they're going to be very worried about demand destruction.
Yeah, for sure. And I think this is part of the bind of the meeting that we're going to have in June. And it's not just Saudi Arabia, don't forget, it's the UAE as well, that has been aggressively ramping up its production capacity in recent years and is kind of itching to use some of those barrels. That's kind of a question for 2 months down the line. I think for now, what OPEC producers will be looking to see is an element of stability in this higher price level. You know, we haven't actually been at $90 a barrel that long in the scheme of oil pricing, right? So I think between now and then, the question is going to be, how does the market look? How does the geopolitical side of the equation look? Which, you know, even from here to Monday, it's pretty hard to have a concrete view on what the market's going to do in the next few days.
Yeah, no kidding.
And so casting all the way ahead to June and having a sort of surety of whether or not there will be barrels being produced either in the Atlantic Basin in the US for various reasons and also in the Middle East. I think we have such a wide spread of outcomes that it's more a case, as OPEC said in their own report yesterday, of monitoring and then judging closer to the time how the market's looking and whether it needs extra barrels.
Alex, you're talking about the traders like Vitol, Trafigura, etc. They're the guys that move things around. What are they talking about in terms of moving oil? Is it hard to move oil now because of the disruptions that we've seen in the Red Sea, etc., or are things okay?
I think in terms of the Red Sea, it's there in the background, but it's not the disruptive force that it was. Again, casting back to IP Week in February, that was a big talking point then when the market at the front end was super strong. We saw a big backwardation at the front of the curve, like strong demand for immediate barrels and prices trading higher as a result of that. We do still have a big backwardation at the front of the curve, but I think the feeling is that the Red Sea isn't as big of a driver there because that was a kind of a 3 to 4 week shift in supply chain that's now being allowed for. So I think on the delivery side, you don't see that much worry. I think where people are talking a lot at the moment is on the demand side and on upward revisions to numbers, even here in Europe, where we're supposedly a kind of a flatline oil demand region, if not falling oil demand region. But you look at some of the gasoline demand numbers, particularly in the Mediterranean, and you're seeing double-digit year-on-year percentage growth. And that kind of runs counterintuitive to the idea that demand should be falling in Europe, and that's before you get into the real demand powerhouses like China. Certainly, again, talking to the traders, looking at some of the figures in the first quarter of the year, lots of numbers were coming in fairly strong, and that's partly what's driven this rampant move higher that we've seen in recent weeks.
So, Alex, the question then that I would have from the economy perspective is, when you have oil prices that are staying at this $90 range, and of course remains to be seen of how long that's going to be the case for, but when does that start to filter it through to consumer prices, whether it's through other transit and logistics costs, jet fuel, things of that nature? When do we start to feel it?
And there's a couple of reasons that there's a time lag, right? Many of the world's biggest consumers will hedge their supplies, and therefore that ripple through effect to consumers takes months to filter through. I think you can make an argument that you are already seeing it to an extent. The CPI data this week, for example, had a higher filter through from energy prices, and I think you'll probably continue to see that in the coming months as I said before, if we assume there's a 2 to 3 month lag, and we think back to where we were earlier in the year, we're now $10 to $15 higher, and with a sort of a related knock-on effect onto things, as you said, like gasoline and jet fuel prices. To Alex's earlier point, the question is what happens then? Do we hold in the 90s as political risk simmers for a few months, or do we have a market that moves higher? And I think, as we shift from a kind of, I think traders are kind of getting used to this idea that inflation might be slightly stickier than expected this year. The question then is going to be, okay, well, how long is it going to be stickier than expected for? And if crude prices and by association refined product prices sort of flatline at a higher level, perhaps the inflationary impact starts to die off. On the other side, if we see big expansions in refining margins or higher crude prices, then that's going to continue well into the rest of 2024.
Alex Longley joining us, Bloomberg oil trader, reporter. Thank you so much. You were like double Alex-plained.
Yes,
I love
and
that
Molly
for
on the
you.
side. It was really nice. You guys just really stole the show.
I love that. Okay, we're looking at Israel potentially bracing for a direct and unprecedented attack by Iran on government targets as soon as Saturday. Of course, that moving to the upside when it comes to crude prices. Brent at the highest level now since October as equities trading heavy. This is Bloomberg.
company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Investors digesting the latest big bank earnings. JP Chase came out with a disappointing outlook for net interest income. Citigroup beat on fixed income trading. Wells Fargo facing pressure to pay out more from deposits. Reaction from Anastasia Amoroso, chief investment strategist at iCapital.
If the Fed does not cut rates and if bank lending is not going to pick up, and that's sort of the status quo that we have today, it's really going to be difficult to see sequential increases in net interest rate margin. So anybody who's overly reliant on that core banking business, I think that's going to be kind of a lackluster story.
Let's check in with some of them. We have JP Morgan right now down about 5%. Citigroup down about 1% right now. Wells Fargo down 0.3. Blackstreet down nearly 2% right now. State Street, that's the only one seen a tick up about 1%. Meanwhile, Morgan Stanley under pressure. The Wall Street Journal reporting the bank's wealth unit facing a federal probe into whether it's doing enough to keep clients from laundering money. Bloomberg's Sonali Basic has more on that.
Significant regulatory bodies, the OCC, the SEC, the Treasury Department, are all looking into what's going on at the wealth manager. And the problem is you don't know the extent of the probe. You don't know what the outcome will be. You don't know if there's reputational damage associated with it. And you also don't know whether there could be fines that would be levied on top of what is going on with the probe. So a lot of questions at one time.
Morgan Stanley down about 1%. To tech, where shares of Intel and AMD, well, they're both down about 3% right now. And this is after a report from the Journal that China telling its telecom carriers to phase out foreign chips by 2027. And Bloomberg reporting Apple getting ready to overhaul its entire Mac computer line with a new set of in-house processors that's designed to highlight AI right now. We have Apple shares. They're up about 0.5%. That is your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele alongside Molly Smith. Paul Sweeney is at Duke University today. We're going to get the lowdown from him on Monday. You're listening to Bloomberg Intelligence Radio. We're live from Interactive Broker Studio right here in Midtown Manhattan. You can also check us on YouTube. We cover all the news for you with instant analysis from our Bloomberg Intelligence crew. They cover 2,000 companies in 130 industries. And we also make sure that we keep you up to date with our world and national news. And for that, we go to Michael Barr. Michael.
Thank you very much, Alex, Molly, and Lisa. Bloomberg sources say Israel is bracing for a direct and unprecedented attack by Iran on government targets as soon as tomorrow, a move that has the potential to trigger an all-out regional war. It said an assault from Iranian soil has emerged as one of the main scenarios expected by the Jewish state and its allies. Iran has vowed revenge for last week's Syrian embassy assault. President Biden is moving to block new oil and gas development in about half of the nation's petroleum reserve in Alaska. Bloomberg government's Zach Cohen reports it's the president's latest bid to boost land conservation and fight climate change ahead of the November election.
Biden is heading into what could be a very difficult re-election race for a second term. Former President Donald Trump is expected to clinch the Republican nomination in July for a second term as well, and the polling has not been favorable for the incumbent president, especially given the lack of enthusiasm from his base, from voters who typically support more environmental regulation.
Bloomberg government Zach Cohen reports the oil industry is warning the president's plan will make it nearly impossible to develop new oil and gas projects in the Arctic. Vice President Kamala Harris is heading to Arizona today after the battleground state Supreme Court ruling put a strict abortion ban from 1864 into effect. Dr. Gabrielle Goodrich of the Arizona's largest abortion clinic says the new law will be a dangerous time for women.
It will harm a tremendous amount of Arizonans, and it'll be terrible.
The timeline of when the new law could take effect is unclear. An anti-abortion rights group is mounting a campaign against a ballot initiative for November to put abortion rights in the state's constitution. Finally, round two has started at the Masters. Bryson DeChambeau leads at 7 under and will tee off just before noon. Tiger Woods, who finished up round one today after his play was suspended last night, is at even and is on the course now. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Alex, Molly?
All right. Thank you so much, Michael Barr. Thank you for, sports, things, golf. The joke is that I know nothing about sports.
Yeah,
I don't pretend
gathered
to.
that.
I used to pretend earlier in my anchoring career, and then I was like, what's the point? You're going to see through me anyway.
Because usually at this point, if it were Paul and I, he would be asking me about tennis, but we will not be talking about tennis today.
I mean, I understand tennis.
Yeah?
Yeah.
Okay.
I'll watch it. I like it. Michael Barr doesn't know where to go with it. He's just looking.
I will say this, is that right now Tiger Woods is at 1 over. The projected cut is 2 over. So he's got to do some hustling to make sure not to get cut, and then because he can set a record.
I actually understood what he said there.
Did you?
I did, yeah. Anyway, here's a good story, Molly. The great headline, tech giant with 30,000 employees has no return to office policy. So apparently this is a software company in Buenos Aires, has open floor plans, curvy desks, great views of the river to Uruguay, the whole thing. But the CEO is choosing not to do a return to office policy across 33 countries. That's really quite interesting.
Can't relate. Really, just
can't relate. I know.
No concept of that.
I've been back since June of 2020.
As we're sitting here in Global HQ, and we know that if Paul were here, how much he loves to thank people for coming in to be in studio. That if you're doing the Zoom thing, that it's not the real thing.
Yeah.
So, this is really just wild, especially if you do have an office with all of these amenities that, I mean, you know, our amenities here I think are pretty great, but like it's, you know, nothing like, you know, a sweeping view of a river to Uruguay, among other things. But hey, you know, there's some bananas, some carrots.
He said that
get to sit here with Alex. It's a nice day.
Yeah, people come and get together. They use the offices in a different way, and maybe that's okay. Anyway, more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele. Alongside Molly Smith, Paul Sweeney is out today. We have a proper sell-off underway here. We have the S&P off by a full 1 percentage point. We're going to dive into that throughout the next hour. Also, talk about tech. There's a report from the Journal that China tells some telecom carriers to phase out foreign chips, which could really hurt Intel. We're going to talk to Mandeep Singh of Bloomberg Intelligence about that in just a moment. And also, it's Muni Friday, so I'm going to flex my muscles and pretend I know things about munis, and Molly's going to help me. And
I'm so excited for that segment.
Oh, girl, you do it. Eric Kazatsky will be joining us from Bloomberg Intelligence. He also gets jazzed about munis. So we got you covered all across the board over the next hour. We also want to get you updated on all the business news you need to know. Here is Charlie Pellet. Charlie.
Hi, thank you very much, Alex and Molly. Here's what's going on. Stocks lower across the board. A lot of red on the screen as we head into the weekend. The Dow, the S&P, NASDAQ all lower. Bank earnings Friday as well. Right now, the S&P down 55, a drop right now of 1%. This update brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Dow Industrials now down 362 points, a drop there of 0.9%. We've got NASDAQ down 220, a drop there of 1.4%. The Russell 2000 cannot ignore that move today, down 1.3%, but perhaps more importantly, now in the red in the year-to-date column. 10-year, 4.49%, with a 2-year, 4.87%. Spot gold today up 2.3%. Gold at a record $24.27 for an ounce of the precious metal. And West Texas Intermediate crude surging as well. WTI up 2.7%, 87.30 right now for a barrel of WTI. Federal Reserve Bank of Boston President Susan Collins is reiterating she sees no urgency to cut rates in the near term, given elevated inflation and the resilience of the labor market. She was interviewed on Bloomberg Radio this morning by our Michael McKee.
Well, policy is not on a preset path. And I think that's important. I think there's a maybe understandable desire to have us map out exactly what's going to happen. But in the current environment, what's really called for is patience, being very methodical, and looking at the whole constellation of information, not just focusing on one data reading or another one.
Boston Fed President Susan Collins, interviewed by our Michael McKee. Bank earnings lower across the board. J.P. Morgan Chase down 5.7%. Citigroup down 1%. Wells Fargo down now by 0.1%. So again, recapping, a lot of red on the screen here. S&P down 52 at 51.46. Drop right now of 1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Really appreciate it. Yeah, that really safe haven bid very much coming into play. Gold, just really stunning to me. Let's get some more details here on the market sell-off. Alexandra Semenova is Bloomberg Equities reporter, and she joins us now. Alexandra, what are you watching today? Lot to watch.
Hey guys, great to be on with you. I know we've covered banks a lot this morning, so I'm taking a look at some other names. Zoetis is one of them. It's a global animal healthcare company. Shares are down more than 7% right now after reports saying that its drug meant to treat arthritis in animals has sickened and even killed some dogs and cats.
Oh
I don't know if you guys saw this article in the Wall Street Journal today. I don't recommend you read it. It's really quite heartbreaking.
Oh my God, this headline.
Yeah.
This is, can I read? This is scary. It
Yeah,
says,
do it.
what killed their pets? Owners blame meds, but vets aren't sure.
It's incredibly sad. A pet owner detailing in the opening anecdote how his 12-year-old rescue dog started taking this medication and got progressively more ill and had to be put down. So now health regulators in the US and Europe are conducting reviews of the firm's drugs after receiving thousands of reports of side effects. So really disappointing. The stock has fallen 18% so far this year.
Yikes, that is a scary
Molly,
one.
you have a dog, don't you?
Oh, no, I'm actually, my friends joke that I am like the last person they would have watch their dog, that I'm decidedly not a pet person.
Oh, gotcha. Oh, okay, because you were talking like
no, I'm trying to emote this feeling of being, heartfelt for the, I mean, look, I'm not an animal hater, but I wouldn't say I'm an animal lover.
It's fair enough, but
I'm
you
neutral.
had me fooled.
I'm a people person.
You're a people, not an animal
Yes.
person. This is all totally fair. What else are you watching?
Also taking a look at Globe Life. Let's see, shares here down, up about 15%. This is a rebound today after the company responded to a short seller report that sent its stock tanking yesterday. It wiped out about half of its market value yesterday after the report. Now the company said it reviewed the report and found it to be wildly misleading. It originally came from Fuzzy Panda Research, which is quite the name for an
Fuzzy Panda Research.
Indeed, I know. It's apparently an anonymous firm that puts out these short positions. So it disclosed a short position in the company yesterday, alleging multiple instances of insurance fraud. It basically claimed that Globe Life had insurance policies written both for dead and fictitious people. So now
And none of that's true.
They're saying it's not true. Investors are kind of buying it clearly since the stock is up today.
Could you sue those people? I mean, I feel like in real world, that seems like a defamation suit to me.
You can definitely, that definitely happens.
Yeah?
Yeah.
Okay.
And, for defamation and all that.
Okay.
Yeah. What does the company do again? Do we know?
It's an insurance company.
Ah, it's an insurance company. Okay, interesting. Actually, because I think some insurance companies today are doing really well. I think Progressive is one of the top performing stocks. Okay, what else are you looking at?
Also taking a look at Marvel, it was down more than 2% earlier, pairing some of that loss, now roughly flat. This is after the company hosted an event focused on artificial intelligence and gave AI sales target. Raymond James said that the 2026 target likely disappointed some, and Cowen questioned the company's visibility over its share capture. Obviously, everyone is treating AI with a little bit more scrutiny. It's not just about talking about it anymore. Now, companies actually have to deliver and have something to show for it. But overall, analysts were pretty positive. Rosenblatt Securities said that the event was well executed and specific in terms of ambitious goals in key areas. And Oppenheimer said that the tone of the event was bullish.
Yeah, Bloomberg Intelligence also saying, sorry to interrupt, Molly, is that Marvell AI event showcased a third major hyperscaler customer in the U.S. and new AI sales target. So they're saying that they're well positioned to capture market share.
I mean, it seems like if you're doing anything AI related these days, this is probably going to be a positive. I mean, looking at Alphabet, they just hit a $2 trillion valuation today. So on this AI rally, so good for them. I mean, it looks like NVIDIA is not at least hitting new records day after day anymore for Microsoft.
Right.
So now it's Alphabet's turn.
But it was really interesting. Did you guys see this? There was an article that we wrote on Bloomberg News about tech companies that showed if you look at their 5-year valuation, for example, we're not at those crazy levels yet, that we're well below that. So yeah, you could say that we're overvalued, et cetera, but not compared to the last 5 years. Did you see that one? I thought that was really quite interesting.
Historically, if you look at valuations, as we get all these talks of there being a bubble, when you compare it to previous years, we're not nearly at those levels. So not
So what does that mean, buy the dip?
Perhaps.
I mean,
for the most part, Wall Street is saying as long as the economic data keeps going, as long as we get strong corporate earnings, then we can keep this rally going.
Keeps going.
Yeah, and they make the argument also in this article that that if you look at sort of the earnings forecast, they're going up at this point for the Mag 7. So that there's actually details and numbers that support the valuation, to your point about Marvell. All right, thanks so much, Alexander. Really appreciate it. Alexander Semenova, Bloomberg Equities reporter, joining us there. Perfect segue, by the way, ladies. Thank you very much.
Absolutely.
Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, is joining us now to break through kind of all of this. There's a lot of news out there, Mandeep. We got Google kissing that $2 trillion valuation, Apple's overhauling its Mac line, China tells telecom carriers to phase out foreign chips. There's a lot happening. What's the most important for you?
Well, the Apple news was pretty big because I think everyone has concerns around what they're doing around AI, and this news points in the direction that the next chip they will have in their MacBook will have on-device AI capabilities. And that's what you expect from Apple. I mean, given they've been designing their own chips for the last 10 years in their smartphone, and they have been, early on that ARM design, focused on power and battery, you would expect them to innovate on the AI side, and looks like that's where we're headed with Apple.
Is this like the next big thing for Apple now that the car thing is not playing out?
I mean, car was always a stretch category for them, even though, when you look at Xiaomi, which was also a handset maker, they have a car on the road. So you could argue, why couldn't Apple do that when Xiaomi was able to do that in China? And look, I think car is a very different category. Probably they realize it's a very difficult market to penetrate right now. And so they're back to what they are doing best, which is around the smartphone side, the PCs, and Vision Pro. I think that could be a big category for them. But for now, cars isn't going to be one.
Mandeep, what's interesting is I feel like what we learned also yesterday from that Mac news and the AI news from Apple is that investors will buy Apple if there is AI in there. like they're like hungry for that catalyst.
And I can name you at least 3 features that I'm looking forward to being an iPhone user. Look, Siri right now is not being used at all. I mean, one thing we know for sure is generative AI can do so much when it comes to virtual assistants, and that too, engaging in an audio user interface. That Siri is underutilized on the phone. Camera, yes, they have got an excellent hardware on the camera side, but in terms of generative AI features where you can use text-based prompts to, change images or do things to your videos, that could be huge. And then messaging, I mean, autocomplete is a great feature, but generative AI can take it to the next level. So all this can be powered by the next chip that Apple is designing, and I think that's what got people excited.
Sticking on the chip theme here, Mandeep, I want to switch over to Intel and AMD, that's Advanced Micro Devices. There was a story out from the Wall Street Journal this morning saying that China has asked its telecom carriers to start phasing out foreign chips. Obviously not good news if you are Intel or AMD here. So tell us how these companies are then going to be affected. It sounds like there's a timeline to get this done by 2027. That sounds kind of soon.
Yeah, I think everyone was modeling the China revenue to go to zero for these companies, whether it's Intel, AMD, or for that matter, NVIDIA. I would argue NVIDIA is somewhat in that same bucket, albeit it's a new category, with generative AI. But anybody, who is selling chips to China for critical infrastructure, whether it's telecom or, with the new large language models, I think it's going to be very tough to maintain that revenue stream given the geopolitical tensions and how important chips are when you think about AI.
But Mandeep, how quickly can both of them diversify their streams? If you're Intel and AMD diversifying their revenue streams, but also China changing their chips.
Yeah, look, I think for Intel and AMD, it's a very tough market because all the hyperscalers already have their own chips on the CPU side. What they don't have is what NVIDIA is selling them. But when it comes to CPUs, everyone has an ARM-based CPU, and that's what makes it tough for Intel and AMD. In terms of diversification, I think Intel and AMD just have to find ways to compete on the data center side with NVIDIA. And look, it's going to be a combination of CPUs and GPUs and other types of accelerators. So a lot needs to change in terms of what kind of chips Intel and AMD are selling. And that will require, product execution and probably domestic manufacturing. I think that's a big bet on Intel that they will be able to manufacture a lot of these accelerators within the U.S.
There's got to be, I would think, some big Chinese chip company that is just waiting to reap the benefits of all of this. So tell us what their landscape is like, if there are some real notable companies that stand out here and are poised to reap the benefits of this move.
Yeah, I think the most notable one is Huawei, right? So we have already seen what they have done on the smartphone side in terms of catching up to Apple, and releasing a smartphone that's comparable to iPhone in China, and that seems to be doing well. And Huawei is the company that everyone is betting on, even on the server chip side and data center side, because they clearly have the scale, the backing of the government, and they manufacture the chips in conjunction with SMIC, which is the local fab in China. So I think right now they are the ones who will likely reap the benefits of this trend.
Do they have the technology to do it solo here, or are they still basing their stuff off of things that Intel and AMD have done?
Well, so I think you need the fab to manufacture the chips. So SMIC is the local fab, and then you need the semi-cap equipment, which is what ASML kind of sells when it comes to the EUV equipment, as well as some other components on the fab manufacturing side. But clearly, they are trying to be self-sufficient, and that's what the goal is when you're, talking about the geopolitical aspect of it.
So Alex was kind of getting at this before with how Intel and AMD might diversify their revenue streams now, but I mean, what other businesses do they do? I mean, isn't it really like, chips are obviously the really big driver here for these companies. So what other options do they have?
Well, chips is a broad category. So Intel and AMD, for the longest time, the majority of their revenue came from selling CPUs. Now, AMD, for matter, they have diversified into FPGAs and ASICs. And so all the, accelerators are different types of chips. So no longer can you make CPUs and that's going to be your primary driver of revenue. You just have to catch up to NVIDIA's, for example, on the GPU side and other type of accelerators. I think custom silicon will be the name of the game. And that's what everyone is rushing towards.
All right, Mandeep, we have like a minute and change left. What's the most important thing you're watching next week?
Well, since earnings is around the corner, you really want to get a sense of how these companies will end up printing, the quarter and the guide, most importantly. So I'm really looking forward to that earnings week, which is the week after next.
Okay, so he's on vacation next week, I think. So we just heard from him.
Just sit pretty, wait for the earnings to roll in.
No, just kidding. We're going to have you on every day. Mandeep Singh, thank you very much. Always appreciate it. Bloomberg Intelligence Senior Tech Industry Analyst, joining us there on all the things to think about. On Apple overhauling its Mac line with an AI-focused M4 chip, with Intel and AMD sort of dealing with the repercussions of a report that China could phase out their own telecom chips. Oh, we didn't ask him about Alphabet, $2 trillion, but that's not there anymore. But it was there for like a second.
Okay. Well, I'm more wondering about, like, whenever I see some of these tech news come across, I mean, you always just think of it more from a consumer electronics perspective. At least I do, as someone who's not particularly tech sufficient or maybe sophisticated.
You're sufficient. You're on a terminal.
I mean, yeah, I should say sophisticated is the better word. Right. So, like, these new, like, chips, like, is the advantage going to make the phone faster? Like, do we know yet? Like, what, like, is the real, like, why are we getting so raw about an
I mean, imagine if Siri was actually really good.
Well, that too, yeah. If she could, like, really solve life's problems.
Yeah, like, if Siri was solid, like, that would change a lot of things.
Do you use her much?
I don't use her at all.
No?
Yeah, but
or Alexa or any of
I
your
do
friends?
use Alexa, but we call her Echo because my name's Alex, so it gets confusing.
Oh, yeah, it would be confusing.
But I find her kind of annoying sometimes. So if she could get better, I would also really appreciate that as well.
Yeah, I don't have one, but my brother does, and all that he asks of her is, like, what's the time, what's the weather? Like, is that what people want? That's it?
I mean, maybe
is that the value add?
I mean, there's got to be something. They just got to come up with it. Anyway, you're looking at a market here where tech is still getting hit the hardest, off by about 1.3%. We have you covered on all the top news over the next hour or so. We're going to take a look at munis. That's coming up next with Eric Kazatsky, Bloomberg Intelligence Senior Muni Bond Strategist. He'll be joining us, particularly if we wind up seeing higher for longer from the Fed. Munis are immune, but for how long? I don't know. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses in the Friday trading session for the Dow, the S&P, and NASDAQ. Right to the numbers here. Fast-moving markets with the S&P now lower by 1%, down 49 points. The S&P at 51.49. We have got the Dow Jones Industrial Average down 340 points now. That is a drop of 0.9%. The NASDAQ Composite Index down 186, a decline there of 1.1%. Russell 2000 lower by 1.3%. The global financial world roiled by a flare-up in geopolitical risk that have sent stocks sliding. We've got the 10-year yielding 4.50% with a 2-year right now 4.88%. Spot gold up 1.5%, 24.07 for an ounce of the precious metal. West Texas Intermediate crude up 2.3%, 87.01 a barrel. BlackRock's long-term investment funds took in $76 billion of net inflows in the first quarter, helping to push the world's largest money manager to a record $10.5 trillion of client assets. BlackRock shares today down 1.1%. At the Masters, round 2 in progress. Bryson DeChambeau sits atop the leaderboard at 7 under par. Max Homa's number 2. Tiger Woods finished his round with a 1 over 73. Again, recapping, stocks lower, S&P down 51, a drop there of 1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, Build America Mutual. Focus on Munis. Let me say this again. Focus on Munis is brought to you by Build America Mutual. Insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM! Insured bonds.
Love it.
We try and get the BAM.
I've
been told
emerald,
my BAM isn't,
with the salt, like
yes. I've been told my BAM isn't that good, so I'm trying.
I felt it. I was like,
felt
woo,
it.
Damn.
She felt it. I got there. Bam. All right, so let's get right to it. Eric Zaski is the man who likes munis. He is Bloomberg Intelligence Senior Municipal Strategist. Eric, I'm going to start with the broad, silly questions on munis. If we have a Fed that stays higher for longer, what happens to munis?
Seeing that right now, right? So we are down about 1% for the month. That's pretty bad, right? We were hoping that April would really be the month where we turned things around from a return standpoint, and we sort of backed out on the U.S. Treasury rate level, all of the perceived cuts that people hoped coming into this year, and we're left with what we have a big dose of reality right now. So we're seeing what the muni market's going to have to bear, and that's really going to be softer returns.
So before we get into it, Eric, I mean, I have to say hello. This is so exciting. I don't know if you guys know this, but when I first started at Bloomberg, I was an intern on the munis team. This was almost 10 years ago.
I think I kind of did know that.
I was known for a time as
you were the muni
Molly.
Yeah.
I believe Eric came up with that name for me. Did you, Eric?
I may have.
Yeah, you may have. I think it's more macro Molly now. But anyways, it's great to see you again.
Yeah, absolutely.
I have just been so caught by why the muni market has seen so much refunding activity this year. When you have rates that are as high as they are, I mean, granted, they're not going up, so or at least right now, we hope. But so I assume that's positive relative to last year. But still, why so much refinancing activity?
So it's interesting, right? Traditionally, and I would say pre-2017, a lot of the refinancing activity that we saw was coming on the exempt side of the market. Interestingly, now, a lot of the refinancing activity we have seen has come on the taxable side of the market. And that has really upset a lot of investors. And I think our news side has really sort of been all over that story that these, BAB, bond holders are very upset because they're, basically their premiums are being taken down to zero and they're being taken out of the market and refinancing. That really has been the driver. I think as rates tick higher, though, that flow that we've seen on the refinancing side is definitely going to slow down. And it's pretty non-existent on the exempt side just because you can't advance refund bonds anymore.
You mentioned that bonds aren't going to return you're not going to get the kind of return that you were thinking you were going to do. But don't we buy the munis for the tax stuff and the dividend? Don't I not buy it for the price?
So happy you said that.
Yay!
Because that's a point we try and hit on all the time, right? It's only a loss if you sell. And I would say the majority of buyers in our space are buying and holding for the long term. So really what this means, right? Returns are down 1% on the year. It just means that there's cheaper things to buy out there. The cost of that 5% coupon, tax exempt, is a lot less than it was a month ago. And I really think that's the story and the takeaway right now.
So not to sound like a back in my day, but at least when I covered munis, it was always so much more interesting to talk about an individual muni story to me rather than the whole market, because you had so many. I mean, this was back when the Puerto Rican debt crisis was really a big thing, and Illinois and Chicago and New Jersey and all of these names of municipalities oh my gosh, their debt is exploding. So tell us right now, what is really, what are some of the markets that you're looking at in particular?
So you guys asked me a similar question last week, and in preparation, I went on MuniOS and I wanted to see, I was what is the most interesting thing I could pick out to talk about?
I'm so glad that you did.
I know, but I'm sorry to disappoint you. Everything is just sort of same old, same old. It's nothing. And I really think this is a driver of just this higher rate market. When Molly talks about when she was covering munis, rates were a lot lower. Financing was a lot easier for a lot of these speculative deals, and it really was more of a Wild West mentality. We had a lot more high yield sales, a lot of stuff in the really low investment grade, and there's really just hasn't been, I would say, the new issue flow that we would like to see to talk about some of these more interesting deals. Believe me, I would love to see it. It just really hasn't happened yet. Maybe if we get that mystery rate cut that they're promising, we can sort of have some of that.
We're calling it a mystery rate cut now.
Well, it's up for debate. Who knows?
I mean, it's a matter of when, though. It's not an if, right? I mean, are you really thinking here there's a less than, or there's a greater than zero possibility that we got another hike?
I mean, our rate strategist is definitely leaning towards that right now, that we're going to get a hike before we get a cut. And that certainly seems like what the tea leaves of the market are saying. Again, not the worst thing for our market. Bad for a return standpoint, great for people who are trying to lock in higher yields at cheaper prices.
Exactly. You clip the coupon, that kind of thing. Yep. So let's get to some of the fun things. So here's one. A Tampa, Florida retirement community financed with about $80 million, I should say, of municipal bonds filed for bankruptcy April 5th and is putting itself up for sale. This is a Tampa. Okay, yes, you know about this. Go.
Well, I mean, when your occupancy is 20%, you're certainly going to run into some problems trying to finance your bonds, right, and pay your debt service. And I think that was really a big issue that we saw in sort of the height of COVID, that occupancy was really struggling in a lot of these senior living centers. Now, it had recovered over the last year and a half, but certainly this is one of those sort of outlier stories that makes you scratch your head. That's how come we haven't heard about it up until this time, right? They're supposed to be providing continuing disclosure documents. You think, eyebrows would have been raised at, someone seeing 40% occupancy or 30% occupancy. 20%, certainly pretty scary, though.
I wanted to ask you as well about higher ed, because this is a part of the muni market as well that maybe is not as out there in your face the way that an Illinois story might be. But there's so many of these small, a lot of liberal arts colleges that just cannot afford to keep running. I think we just saw another in Vermont this week that looks like that they're going to shut down because the enrollment numbers just aren't there. I mean, are these bonds are these schools, that a lot of people are invested in, that there's a lot of investor exposure to something like this?
There's a lot of investor exposure, sure. I mean, something I can point to, right in my backyard is LaSalle University. They recently sold a deal, and if you just sort of contextually, right, the rates they sold it at were almost 6.75% at par. On a taxable equivalent basis, it's almost 12% yield on bonds for a school that has been around a very long time. Yes, they're struggling with enrollment. Yes, they're struggling financially, but they have a lot of real estate and they have a lot of land that is worth something, right? So certainly for the investor who wants to get down the weeds on credit, it presents an interesting opportunity. And I think there's a lot more of those stories out there.
Any other cool things going on? Random issuance things that are cool and interesting?
Random issuance things. You know what? I don't think from a random issuance things. I think more just what we need to sort of keep an eye on is what this higher rate, environment is really going to do to new issue sales. And we have seen definitely the sort of rollover as far as rates go and as far as the calendar has gone. We went from about 16 billion on the forward calendar to about 10. And I really do think a lot more deals are going to be pulled if rates stay in this higher environment. And that's really not good, right? Because we want more price discovery and we want more activity in secondary trading, and all that sort of feeds upon itself.
I have a stupid question for two muni people. if I need the money, if I'm a municipality, how can I just pull a deal? Like, don't I need the money and I got to do it anyway?
Well, there's other avenues they can go to, right? They can go to direct bank loans, which we've seen more and more activity on. And, you could save on cost of issuance, and you could also have less restrictive covenants in place if you go that route. I'm sorry, I'm apologizing to all of my banker friends out there by saying the quiet part out loud, but they definitely do have options on the table.
Man, I remember we used to really parse through those, and obviously this is the really exciting part about covering bonds when you look at all of the documents that dictate what you can and can't do with the money. I mean, that's just some really heavy legal speak in there that I'm sure Eric is all too familiar with.
Absolutely, yes.
All right, Eric, thanks a lot. Super appreciate it. Thank you so much. I always learn stuff when we get to the Munis in Focus segment. Eric Kazatsky, he covers Munis for Bloomberg Intelligence. And just so you're wondering, something that Molly and I have been watching, and I appreciate we're on radio, so this may not mean that much. Did you see the baby penguins?
I've got this Michael Barr is looking at us like, what's going on here?
Did you guys see this?
Yes, I did.
It just came to my attention today. So apparently National Geographic was able to film baby penguins diving into the water in the Arctic for the first time.
Yeah, but this was a deep dive. They jumped off a cliff instead of a little bit boop, just into the water.
I think it's cute. Other people that I've sent this to have said it makes them anxious because all the penguins are pushing each other and then they just get sloughed off this iceberg thing rather than nicely jumping and being happy about it, but nonetheless.
I've got this video running and I'm waiting for it to happen, and they're getting right up on the edge there, and a little part makes me nervous, I gotta say.
I love it. Oh my gosh, you guys, if you haven't seen it, I highly recommend it. It just makes me happy. All right, let's go to Michael Barr, World and National News.
Oh my, Alex, Molly, Charlie, thank you very much. Sources tell Bloomberg Israel is bracing for a direct and unprecedented attack by Iran on government targets as soon as Saturday. It's a move that has the potential to trigger an all-out regional war. National Security Council spokesman John Kirby says the U.S. is doing what it needs to do in the region.
We are making sure that we can protect ourselves and our facilities as well as doing what we have to do to help Israel defend itself.
National Security Council spokesman John Kirby. Former President Trump and House Speaker Mike Johnson are set to appear at a joint news conference later today at Mar-a-Lago. The presser about election integrity comes as Johnson is facing pressure from Trump ally Congresswoman Marjorie Taylor Greene to be removed as Speaker. Today, the House will vote on reauthorizing the Foreign Intelligence Surveillance Act. A yes vote renews FISA for 2 more years instead of 5. Yesterday, FBI Director Christopher Wray told lawmakers that the U.S. is facing more threats from foreign adversaries and appealed to Congress to renew it. Bloomberg's Amy Morris is in Washington.
Wray appeared before the House Appropriations Subcommittee hearing on the fiscal year 2025 budget request for the FBI. But he told the panel that failure to reauthorize FISA would be dangerous for the country.
As I look back over my career in law enforcement, I would be hard-pressed to think of a time where so many threats to our public safety and national security were so elevated all at once.
Wray says threats to the U.S. from foreign terrorists have been rising since Hamas attacked Israel on October 7th. In Washington, Amy Morris, Bloomberg Radio.
The once best friend and former interpreter for Dodgers superstar Shohei Ohtani will appear in a Los Angeles federal court this afternoon. Yesterday, Ippei Mizuhara was charged with bank fraud for allegedly stealing $16 million from Ohtani. Global news 24 hours a day and whenever you want it with Bloomberg News Now.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all trading lower. We're off the lows of the morning on the S&P. Right now, though, still a loss of 47 points. 51.51 right now on the S&P 500 index. A drop now of 0.9%. The Dow down 317, lower by 0.8%, while NASDAQ, the composite index, down 168, drop there of 1%. The NASDAQ 100 index down 1.1%, and the Russell 2000 lower now by 1.2%. 10-year at 4.51%, the 2-year 4.88%. Spot gold advancing by $19 the ounce. 23.92 was above 2,400, up 0.8%. West Texas Intermediate crude up 1.6%, 86.35 for a barrel of WTI. The global financial world roiled by a flare-up in geopolitical risks that sent stocks sliding. Also, we got new numbers on inflation, with the Labor Department issuing its third inflation report of the week. The import price index top forecasts, as we hear from Bloomberg's Vinny Del Giudice.
U.S. inflation remains an issue based on the past week's inflation data, and there are doubts about the pace of Federal Reserve easing. There's been a U-turn in the bond market on the prospect of lower interest rates. It's wiped out last year's fixed income gains. TD Securities, for example, now sees the yield on a 10-year U.S. Treasury note reaching 5%. Or even higher. Vinny Del Giudice, Bloomberg Radio.
And on top of the economic data, earnings very much in focus, specifically banks. J.P. Morgan Chase after earnings down 5.3%. Citigroup after earnings down 2.9%. Wells Fargo after earnings down 0.4%. Recapping, stocks lower. S&P down 49, down 1%. 10-year at 4.51%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet. I'm Alex Steele here with Molly Smith. Paul Sweeney is off today. This is Bloomberg Intelligence Radio, where we give you all the news, all the analysis with our great Bloomberg Intelligence team. They cover 2,000 companies and 130 industries all around the world. We also like to bring you kind of boots on the ground scenario with some CEOs that sort of are in the trenches. They do the stuff. They know the things on a deep level. And one of those companies that we want to focus on is Generac. It's basically a generator company, but it's going to be so much more than that in the world of the energy transition. It is an $8 billion company. The stock is down by about 1.5% today, but it's a tough tape. Previously, it has been on a tear. It's an interesting company. It's a leading global energy technology company that provides backup and prime power products and energy storage. And if you follow the energy transition like I do, you know stuff like this is key to making all of this work. Well, the CEO joins us now in studio. Aaron Jagfeld is the CEO of Generac, and he joins us in the Bloomberg Interactive studio. Thank you for being here, Aaron. Really appreciate it.
Thanks for having me.
So on a basic question, when we look for the energy transition, so as we look to decarbonize, where do you sit in that journey?
Yeah, so, there's a lot of things to unpack even in that statement.
Right? I know, that's why I asked it.
The transition itself, right? Is it grid 1.0 to 2.0? We like to refer to it as old grid to new grid. Mm-hmm. And so the challenges that grid operators and utilities face today is being compounded by the fact that we're retiring on the sources side. We're retiring a lot of the traditional thermal assets like coal plants and gas plants in favor of renewable, which is great, but those are intermittent sources. So a lot more difficult to plan for and not available, as by the very nature of the word intermittent, not available all the time. And then on the demand side, we are seeing inflection points in demand. After decades of relative kind of flatness in energy demand, we're now seeing increases in demand with EV adoption. We're seeing, of course, AI with data center build-outs, cryptocurrency mining. And so the pressure that's being put on grid operators and utilities is creating a situation where it's manifesting itself in poorer reliability. So as Americans, we're experiencing more and more hours in the dark every year. So on average, about 8 hours a year, and that's the average. So our products and our company have been serving this need, the need for resiliency, for a long time for homeowners and business owners. And so where we sit today is those products are in high demand and have been over the last several decades. And we're now starting to look at some of the other trends that are manifesting from the macro theme here of a new grid. And it's really going to be focused on cost. I think the untold story here going forward, and we're starting to see evidence of it in certain markets like California, where energy prices, electricity prices have really skyrocketed. In the US, they've gone up about 50% over the last 2 decades. They're projected to double in the next 2 decades. So I think this is the thing that, as we invest in this transition of the grid and as we try to deal with some of the challenges that are coming here, the combination of less reliability while you're paying more for that service is not a great combination. We think we have products and services that can help with that.
Well, let's get into the cost, because we've been looking at this from, I think I was telling you I cover the U.S. economy for the most part. This is my little side hustle in here, but on the outside, when we're looking at what all of these costs to consumers are, electricity, utilities broadly have really been going up, especially if you're in an area where you're affected by climate and natural disasters. So how is this transition? I mean, it sounds like it's going to be probably more expensive and then hopefully be, a cheaper alternative in the long run. How do you see that playing out?
From our vantage point, certainly costs are going up. And I, as far as if it works out cheaper in the long run, I think it'll be cleaner in the long run. I think that, I think the effort here that is driving a lot of the costs, there's a couple things. One, the grid is just old, right? When if you take a walk and you go anywhere in most places in the U.S., the grid is above ground. There's poles, there's transformers, there's power lines. A lot of that equipment has been there for 50 plus years. So it's like a road or a bridge. At some point, it has to be refreshed. And so there's an infrastructure spend anyway. If you set aside the entire discussion around climate change, there still was a big bill coming in terms of needing the infrastructure rebuild. Now, on top of that, as we decarbonize and we move towards renewables, and we have to deal with this idea that these sources are going to be intermittent and harder to plan for, and we need more of that power, you've got this unique setup that says, okay, we've got to invest in technology in a way that we haven't had to invest before when you're talking about the power grid. And the grid is so central to everything we do as homeowners or business owners.
Do you think that it's going to be more you providing generators is it going to be more providing generators or providing the grid with storage for like wind and solar?
I think it's going to be both, right? So generators are going to be, if you're concerned about a long duration outage, right? If you have hurricanes, ice storms, things like this that can knock out the power for days on end, a generator is a great, that's an asset you're going to want to own. Mm-hmm. The idea though is that asset could also be deployed maybe at times when you don't need it, but maybe when the grid does, right? So there's ideas that the generator could be part of that solution. Batteries, as you say though, Alex, is exactly I think the newest technology. Still from a price standpoint, still pretty expensive though. And that's something that I think we've got to deal with. And the cost curve it's been coming down, but yet it's still something that, it's not there yet.
So I was in so I cover energy for my side hustle. And
your main hustle.
It's semi-hustle. So the data center conversation is huge in terms of how you power it. And we've seen like Amazon buy like a nuclear power center like near where they're going to build stuff. Are you going to be like going to tech companies and being like, hey, I can build you this enormous generator for your data center?
That's not necessarily us. I mean, we're going to stick to smaller installations. We call them behind the meter installations. So managing power, either backing up power or managing it behind the meter. So at the customer connection, again, home or a business. But the AI conversation has, I think, I don't want to say it's caught the utility industry flat-footed, but the projections are enormous. It kind of has. I mean, the speed at which it's the adoption of technology. A single Chat GPT request takes 17 times the amount of energy as a typical Google search. 17 times, just a single Chat GPT request. So think about that, and you multiply that across all the places that you can use that technology, AI, and it's going to be fantastic and it's awesome, but it's really energy intensive.
Wow. I've never heard that number before. That's scary.
Yeah, and we got so used to power demand not growing at all, and then all of a sudden just the trajectory is enormous, and then how you kind of manage that. So, to Molly's question, the way that I look at it is absolutely everything's going to cost more. I think the question is who's actually going to pay for it. Is it the government and then taxes? Is it?
I got news for you. Anything that costs more in the energy world, the ratepayers.
Yeah, us.
Right?
Like at some point,
that's exactly it.
We're going to have to raise the rates. Aaron, thanks a lot. That was really fun. You should definitely come back.
Awesome.
Aaron Youngfeld joining us. He's CEO of Generac. They're basically a power backup company. So really interesting stuff. Anyway, more coming up. This is Bloomberg.
Company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Bank stocks are trading lower. JP Morgan Chase reported net interest income that slightly missed analyst estimates and raised its expense guidance for the year, sending shares lower. JP Morgan Chase now down by 5.3%. CEO Jamie Dimon citing a number of risks going forward, including wars, growing geopolitical tensions, persistent inflationary pressures, and the effects of quantitative tightening. Again, JPM down now by 5.3%. Citigroup's profit topped analyst estimates as corporations tapped markets for financing and consumers leaned on credit cards, signs that a prolonged period of elevated rates will benefit big banks. Citigroup shares today down 2.5%. Also reporting this morning, Wells Fargo, it missed estimates for net interest income in the first quarter, a sign that muted loan growth and increased pressure to pay out more for deposits are eating into the benefit of higher rates. Wells Fargo shares, they are down now by 2.5%. Apple is preparing to overhaul its entire Mac line with a new family of in-house processors designed to highlight artificial intelligence. Mandeep Singh is a senior tech analyst at Bloomberg Intelligence.
I mean, look, everyone has been waiting for that Empire Strike Back moment when it comes to Apple, because clearly they still have that install base and distribution on the smartphone side, and also I would argue on the notebook and PC side. And look, they control the chip and the operating system, so that's unlike a lot of other companies on the PC side where Dell or Lenovo relies on, Intel to give them the chips.
Bloomberg's Mandeep Singh, Apple right now up 0.7%. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Friday, everybody. We made it. I'm Alex Steele alongside Molly Smith. Paul Sweeney is off today. You're listening to Bloomberg Intelligence. We cover all the top news with our analysts that cover 2,000 companies in 130 industries all around the world. We also keep you updated on all the news, world and national now, with Michael Barr. Michael?
Thank you very much, Alex, Molly, and Charlie. Israel is bracing for a direct and unprecedented attack by Iran on government targets as soon as tomorrow. That's according to people familiar with the Western intelligence assessments, who say the move has the potential to trigger an all-out regional war. National Security Council spokesman John Kirby just told reporters he could not provide details, but the U.S. is doing what it needs to do to protect personnel and facilities in the region, as well as to help Israel protect itself.
This is a serious threat. We're watching it very, very closely. We have been and will continue to stay in close touch with our Israeli counterparts about preparations for this threat, making prudent adjustments on our own.
An Iranian missile and drone barrage would represent a retaliation for a deadly strike on its diplomatic compound in Syria last week, which the Islamic Republic blames on Israel. The NYPD says security will be tight when former President Trump's hush money trial begins Monday. Selection will begin to find a dozen Manhattan residents who will become the first Americans ever to sit on a jury of a former president charged with a crime. Trump faces charges he falsified business records to cover up a long-denied affair from voters. President Biden is chipping away at student debt once again. We get the details on the latest move from Bloomberg government's Zach Cohen in Washington.
The Biden administration did say it will forgive another $7.4 billion in debt under its current SAVE program, sort of the income-driven repayment program that is moving forward and has helped hundreds of thousands of Americans get their debts even erased at this point.
Bloomberg government Zach Cohen reports this latest move will cover about 277,000 Americans. Finally, round two is underway at the Masters, and now there's a tie for the lead at 7 under from Max Homa and Bryson DeChambeau. Scotty Scheffler is one shot back. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Molly, Charlie.
All right. Thank you so much, Michael Barr. Really appreciate it. So we've been talking about housing kind of throughout the last couple hours, and here's a really interesting article. Basically, these cheap 30-year fixed mortgages are now deterring workers from relocating for jobs that could pay as much as $250,000. That is unbelievable. And I have to wonder, what do you do as a company that's trying to get those workers and woo those workers?
Offer relocation. That's the whole point of this story.
Plus.
Yes, exactly. I mean, this is really when we talk about like how so many Fed officials are cognizant of that. You know, you look at mortgage rates and interest rates broadly as high as they are, and like why, you know, broad swaths of the population are not really affected by it. This is why, that people have locked in these low rates. I mean, you, Alex, like yourself, sub
2.75, baby.
Exactly. Don't move. That's the whole philosophy here, and that these people are not going to move. And these are in parts of the country we're talking about in the Midwest, in the South, like places that you would think 250 grand. I mean, That's not nothing really anywhere, but in those parts of the country, you would think that would go a lot further. But that's also the trade-off that people are realizing, that these are not places that are, used to be as affordable as they were.
So this is the interesting part. About 1/5 of U.S. homeowners have a mortgage rate with less than 3% interest. Almost 35% have a rate between 3 and 4%. This is according to Bloomberg analysis of Federal Housing Finance Agency mortgage data. Now, current rates on 30-year fix are 7%.
And so few people actually pay that.
It's true. But even if you buy some discounts rates and stuff, okay, at best you're looking at 6, maybe 5.75, and I'm just being generous at this point. And that's so interesting, because if you're a company and the labor market's already tight, and then you can't get the worker that is qualified to come to you, even if you pay $250,000, that's a serious mismatch of the Fed's doing.
And now you're going to have to buy this new, this job seeker a house if they're going to move for you.
Oh, yeah. The only way I'm moving it is if someone is, paying off some of, I don't know, lots of incentives. Anyway, Molly Smith, wonderful to see you. Thank you very much. Bloomberg of Power is up next with Joe Matthew. Happy weekend, everybody.
Politics to the world of business. This is Balance of Power. Live from Washington, D.C.
Don't look now, but Congress might actually get something done today. Welcome to the fastest show in politics. As the House prepares to vote on renewing the Foreign Intelligence Surveillance Act, they're voting on amendments right now, even as Donald Trump prepares to appear at Mar-a-Lago with Speaker Mike Johnson. He's not a FISA fan. We'll get a live report from Zach Cohen. He's on the Hill at Bloomberg Government. President Biden throwing down another marker in the South China Sea this week. We'll talk with Bloomberg opinion columnist Andreas Kloof about the trilateral meeting with Japan and the Philippines and what could, for this administration, be an even more immediate concern in Israel. Our panel today, Rick Davis is with us, Bloomberg Politics contributor, along with Democratic strategist Pat Dennis at American Bridge. We've got a lot to cover on this Friday, and we start, as always, on Wall Street. Let's get to midday trading right now with Charlie Pellet in New York. Hey, Charlie.
Thank you very much, Joe Matthew. It has been quite a week, and today the focus very much on earnings and ongoing geopolitical tensions. We are looking at a down day right now for the Dow, the S&P, and NASDAQ. S&P slumping 50 points, down by 1%. The Dow now lower by 318 points. That is a drop of 0.8%, while NASDAQ is down 183, a decline there of 1.1%. The global financial world is being roiled by a flare-up in geopolitical risk that has sent stocks sliding. The 10-year right now at 4.50%, with a 2-year that's yielding 4.88%. Gold surging $22 the ounce to $23.94, was above $2,400, trading at a record up 0.9%. West Texas Intermediate crude up 1.5%, 86.31 a barrel. Federal Reserve Bank of Boston President Susan Collins is reiterating she sees no urgency to cut rates in the near term, given elevated inflation and the resilience of the labor market. Collins was interviewed this morning on Bloomberg Radio by our Michael McKee.
I do see policy as being moderately restrictive at this point, and it, in my view, will be appropriate as we get closer to that trajectory. It will be appropriate to begin easing, but we're not there yet.
Susan Collins, president of the Boston Fed. Stocks lower, banks declining as well after earnings. J.P. Morgan Chase down 5.3%. Citigroup after earnings down 2.8%. And right now we've got Wells Fargo trading lower by 0.2%. Recapping, stocks lower, S&P down 52, a drop of 1%. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington. And once again, here he is, your host, Joe Matthew.
Hey, Charlie, thank you. Welcome to Friday. Always a pleasure to meet you at the threshold of the weekend, although we've got a lot to get done here today before we call this a week. And it starts here in Washington. We could end the day in Palm Beach. We talked about that, the Mar-a-Lago event with Donald Trump and Mike Johnson. There's actual business taking place in the House of Representatives right now. This is about the FISA renewal. Around this time yesterday, it was thought to be dead after the rule failed on the floor. If you're with us on YouTube, we're showing you a live view of the floor now as debate continues around amendments to the Foreign Intelligence Surveillance Act, remembering that the real sticking point here is about whether a warrant should be required to collect data on Americans, at least to keep data on Americans who are scooped up in our surveying of foreign actors. This would be a big deal for Mike Johnson if it passed. That's how low the bar is right now. Just to get the rule through so we can have a vote on the real thing today was a big deal. They started early this morning after a late night in the Rules Committee, and everybody's going to be, trying to forecast what this will mean for things like Ukraine aid or other things on the agenda that everyone had written off. Let's start with Zach Cohen. He's on the Hill right now reporting for Bloomberg Government. Of course, Zach has had his finger on the pulse here, the on-again, off-again situation when it comes to FISA. Zach, is this going to pass today, and in what form?
The key question is actually just the first vote in the series that you all are watching now, this vote on an amendment from Congressman Andy Biggs, a hardliner Republican from Arizona, which would impose this warrant requirement on surveillance of foreign nationals, which does tend to include from time to time American citizens, which is obviously the concern, especially of civil rights organizations. This is one of those bills that will pull together sort of strange coalition, strange bedfellows, if you will, in the House. This particular amendment is brought by Biggs and Pramila Jayapal, who's the chair of the Progressive Caucus. And so whether this particular amendment passes will determine, what the next steps are. It's heavily opposed by the intelligence chairman, Mike Turner, the Biden administration, worry that it would make it more difficult to get some of these surveillance authorities approved on a case-by-case basis. And so if this bill does get through the House today, it still needs to be approved by the Senate, where Senator Mike Lee and other civil rights advocates and critics of FISA as a whole will need to take a look at it and get it through before the April 19th deadline.
Just so our listeners and viewers understand, Zach, what does Andy Biggs' amendment call for? What would it do if this passed?
It essentially imposes a sort of this warrant requirement that you mentioned. Right now, the power of FISA, the Foreign Intelligence Surveillance Court, and the act that underpins it allows the federal government to surveil foreign nationals really at its own discretion. There is the secretive court that oversees that process. It's the same law that pulled in the Trump campaign in 2016. It's part of the reason why Trump successfully killed the first consideration of this bill earlier this week over concerns that there weren't enough protections in it in the first place. Now, the Biggs amendment it might fail, and we should point out that the Trump campaign was surveilled not under Section 702, which is the surveillance of foreign nationals, is the part that's being reauthorized now, but under a separate section because he is, of course, an American citizen. We should clarify that.
Yeah, this is 702 that we're talking about here, and everyone's going to ask later today, Zach, and it'll be people like me asking you what it means for the rest of the agenda. If this passes today, and I think I know how you're going to answer this, what does it mean for aid in Ukraine? Or do we have to wait until Mike Johnson spends some time at Mar-a-Lago this weekend to find out?
This is the last vote in the House for the week. Johnson is on his way to Mar-a-Lago today to meet with President Trump on an election integrity effort. We're still trying to learn details on exactly what that would entail. But our colleague Eric Wasson has been hearing that Ukraine aid is next on the agenda in the House. Now, likely won't clear if they make any changes to it over in the Senate before the recess. That would takes place around Passover this year. But certainly that Ukraine package that has been stuck in the House for months at this point after it passed the Senate is the next item of the agenda. Clearly, the issue there being Congresswoman Marjorie Taylor Greene, the Republican from Georgia, has threatened to try to oust Speaker Mike Johnson if he holds a vote on that package. He and others are trying to make some changes to it that would make it more palatable to the rest of the House Republican Conference. Of course, there is likely a bipartisan majority in favor of the Senate bill as is. The question is whether they can get the votes on the floor to pass a rule in the first place, or if there's a two-thirds majority for it in order to suspend the rules and pass on a wider bipartisan majority. And so if they do make any changes to it, look for the Senate and see if they're able to then send it to the White House for President Biden's final approval.
Got it. Is Donald Trump going to save Mike Johnson from Marjorie Taylor Greene?
it doesn't seem like there's a lot of appetite to begin with for Green's effort to oust Johnson. I think House Republicans remember very clearly the long, arduous process of finding Johnson to begin with, to after the motion to vacate the chair that led to then Speaker Kevin McCarthy's ouster. And no one really has seen somebody else willing to step up and take that mantle from Johnson, especially just about 6 months away from the 2024 presidential election, where chaos in the House would certainly hurt Republicans' pretty good chances of retaining the House majority. And so Trump could certainly lean in on Johnson. The FISA is one of those issues where they obviously disagree. Johnson's been pushing this reauthorization. Trump very clearly wants this authorization to expire.
It's going to be fun to watch later on. I'm sure you'll have your eyes on it. Zach Cohen, great to see you. Welcome back, as always, on Bloomberg. Watch for his work on the terminal and online. Zach Cohen at Bloomberg Government reporting on the voting that's underway right now. As you just saw, if you're with us on YouTube, the Biggs Amendment is getting debate and voting. We do expect a vote on the full bill once we get through this, likely before this program is over, and we'll keep you posted on this. We'll have the panel weigh in a bit later as well. As we come off a very important day in Washington yesterday that was shrouded by so much noise in the political space, in any other world, a trilateral meeting between the United States, Japan, and Philippines that will likely result in a more formal alliance in the South China Sea, an alliance against China, would be front page news. But we've got FISA coming and going. We've got Trump doing this and that. We've got the abortion ruling in Arizona that's taking a lot of attention here. There's almost no time to get to it all. And I was heartened to see the column today by my colleague Andreas Kluth, reporting for Bloomberg Opinion from here in Washington, D.C. Hail the trilateral chiefs, Biden, Kishida, Marcos. Indeed, this is important and worth your attention as the president tries to put together a network of alliances that some people are calling a Pacific version of NATO. Andreas is with us now on Balance of Power, and it's great to see you, sir. You talk about the lattice work of alliances, the mini-lateral partnerships. Is it possible to connect the dots on all of them?
It's hard. In fact, I believe my title made fun of that, like mocked that, because I think I said, hail the mini-lateral chiefs, you know? But basically what you have is, by my count, 3 trilaterals and 1 quadrilateral, all overlapping in the Indo-Pacific, all led by the U.S., and it forming what they call, you know, their metaphor now, it is a lattice. What does the lattice replace? It replaces what's emerged since World War II in the Indo-Pacific, but not in the Atlantic, which is in the Indo-Pacific. You've had a hub and spoke system. So the U.S. has bilateral alliances with security guarantees with Japan, Australia, New Zealand, the Philippines, Thailand. But there was no thought. Some of these countries were acting independently, or in the case of South Korea and Japan, were even hated each other. And the U.S. has been, under Biden, trying to bring some order into that and make it, as I said, a lattice. Whether that works for you or not, we can debate. And of course, one thought that they have in their mind is the other side of the world, which is NATO. 75th anniversary just passed, and Biden will host in July, will host this year's NATO summit in Washington, which is this incredibly successful alliance. All alliances are supposed to deter. The lattice is supposed to deter China. NATO is supposed to deter Russia, always has done. But there's a problem in NATO, which is burden sharing. So a lot of the allies are free riding on American defense spending, and Biden wants to prevent that. And I think if you want to be kind and generous, he wants to build a new and improved NATO, a NATO 2.0 in the Indo-Pacific for what they view as the larger challenge for the next 75 years, which is likely going to be China.
Well, let's go a little deeper into that, because we heard from the president yesterday as part of that trilateral meeting. And I want to ask you, Andreas, about enforcement. We talked so much about Article 5 in Europe. Listen to what he said about the Indo-Pacific region when he spoke yesterday, and we'll talk about this on the other side. Here's the president.
The United States defense commitments to Japan and to the Philippines are ironclad. They're ironclad. As I've said before, any attack on Philippine aircraft, vessels, or armed forces in the South China Sea would invoke our mutual defense treaty.
So, Andreas Kluth, it sounds like there is an equivalent to Article 5 in the Pacific. Isn't that what he just said?
Yes and no. The difference, so this defense treaty with the Philippines goes back to the 50s, I believe. It's old. Mutual defense guarantee. That's what all the treaties I mentioned earlier have. Article 5 of NATO is different. It says an attack against one is an attack against all. In theory, it obliges all 32, with Sweden now, allies to come to the defense of any of them. It's only been invoked once.
So the Philippines and Japan would not come to our defense, in other words, if we were attacked?
Well, they're not in NATO. I was saying that was Article 5 in NATO. What he
Understood, but I'm trying to discern the difference between these two.
Exactly. And so here, the U.S. would come to the defense of the Philippines or of Australia, but Japan wouldn't have to, is not in the treaty. And that's the difference with the lattice and the trilaterals and quadrilaterals. Biden wants, and Japan, Kishido, in this very moving speech to Congress, maybe we should go into that because I thought it was powerful, essentially signaled, we're sharing this burden with you. We would also help, even though Japan has no formal treaty at present with the Philippines, for example. So you see, that's the difference, a bilateral defense guarantee versus a multilateral. And that's where the minilateral and the attempts come out, that the U.S. doesn't want all by itself